All right then, welcome everyone to Pacific Northwest Tax School's course called Federal Tax Credits for Business and a recently added new component, the ACA Employer Health Insurance Mandate. The course has always just been about credits, but because one of the main credits I talk about in this course is the credit for small employer health insurance premiums, I felt that it harmonized well to have a discussion about health insurance mandate for large employers who aren't necessarily eligible for the small employer health insurance credit. But the two topics tie together nicely, and this just seemed a place to throw them in. So I've changed the name of the course to throw in the ACA Employer Health Insurance Mandate. So we're going to be talking about that for a while today, as well as a very lengthy discussion, in-depth look at Form 3800 and some of the more likely credits tax practitioners are going to run across in the active conduct of preparing tax returns for small business clients. So let's take a look then. You should have printed the manual that you see on the screen in front of you, and if you haven't already done so, you can go back to Open Campus, our learning management system, and click on the Materials tab. That's where you can find the manual and print a copy for yourself. You don't need to panic about it right this second. There's going to be 3 breaks during today's class, and you can go back and print it during one of our breaks. Also today, I'm going to be giving a series of 3 passwords. They're going to be randomly spaced throughout today's class. Be sure to write down each password as it is given, as it is your evidence that you actually sat through and attended today's class. At the end of the webcast, you will need to return to the Assignments tab and complete the password test. You do need to get 100% of the password test to show that you attended today's class. After that, you will be able to print your certificate of completion. So let's move on to page 2 of the manual, and we're going to start with some really basic stuff. I'm sure you know it already, but I just feel that we need to have this opening piece for you. We're going to talk briefly about refundable versus non-refundable credits. Because a tax credit is a pretty good deal for a lot of people. It's often better than a deduction, but not always better than a deduction. So it's worthwhile to really pay attention between how a credit works, how a deduction works, and then how a refundable credit works, of course. So a deduction allows you to reduce your taxable income, and how much tax you save because of a deduction varies according to the tax bracket you are in and whether you have taxable net income. It can also be affected by the income level you are at itself, because certainly with personal credits, income can affect your entitlement to a credit and take it away from you when your income goes too high. Deductions, that sometimes happens as well, but it's more common for it to happen with credits. The deduction, if you were looking strictly at how deductions versus credit works, a deduction of $1,000 can save you for $150 if you were in the 15% tax bracket, but it would save you $280 if you were in the 28% tax bracket. So deductions, how well or how much they benefit you, can depend on the income tax bracket you are in, and the higher the tax bracket you are in, typically the more a deduction will save you. But a credit is always dollar for dollar. If you happen to qualify for a credit and the credit is $500, it will reduce your tax by $500 regardless of what your income is. Most federal credits, and usually state tax credits as well, are non-refundable. And this means that they can reduce your tax to 0, but they cannot create cash back. And with a few exceptions, most federal credits must be claimed in the current year and cannot be carried forward. That is the case with individuals, but when it comes to business credits, the way that the general business credit works actually does allow for carry forward for up to 20 years. So individual credits that typically have no carry forward provision, not always, because for example, the foreign tax credit has a carry forward provision. Unlike individual credits, business credits often do have a carry forward provision. Here's another illustration about how credits can work or maybe not work for you. If your liability was $600 and you had a $500 credit, your net tax would be reduced to $100, and you would actually fully benefit from that $500 credit by saving $500. But if your tax is only $400 and your credit was $500, your allowable credit would be $400 and the difference would be lost. That is the case with individual credits, but again with business credits, the business credit provisions actually allow for a carry back and then a carry forward. So that $100 could potentially work for you in the future. So non-refundable credits typically do not allow for any kind of benefit other than potentially a carry forward or they're lost, but refundable credits do allow you to receive a refund back if you were not able to use the credit to offset all of your tax. So for today, we're going to spend most of our time talking about the general business credit. General business credit is made up of many, many different types of credits. All of these credits are claimed or figured on their individual credit forms, and then after the credit has been figured, it carries over to the general business credit form, and then the general business credit form is used to determine whether or not you're going to be allowed the credit, how much of the credit, whether there's going to be a carry back, whether there's a carry forward, and so on. So let's take a look at Form 3800, which is the General Business Credit Form. The General Business Credit is claimed on business tax returns only, with the exception of individual Form 1040 filers who are filing Schedule C, E, or F, or who are claiming credits from flow-through entities such as partnerships and S corporations. The General Business Credit is a non-refundable credit. However, the credit can be carried back 1 year, or in the case of 2010 qualified small business credits, carried back 5 years, and then it is carried forward 20 years until it is lost. So how do you go about claiming the general business credit? Well, to claim a general business credit, you begin by completing the form you need to figure for the current year business credit that you are claiming, and then you enter the calculated credit amount on the appropriate line of Form 3800. Form 3800 needs to be filled out to claim any of the general business credits, and the credits are used on a first-in, first-out basis by offsetting the earliest earned credit first. Therefore, the order in which the credits are used in any tax year is carried forward to that year, with the earliest ones first, and then the general business credit that is actually earned or figured for the current year, and you need to complete and attach the appropriate source form for that credit, and then finally the carryback to that year. So if you still have tax liability this year, but the next year you don't have a liability and the credit is all used up, then it could carry back. And of course, you have to do amended returns to figure that. For individuals who are filing Form 1040, the general business credit is claimed on Form 1040 line 54, and then you check box A. Let's talk a little bit about carry back and carry forward of unused credit. The general business credit is a non-refundable credit. However, if you cannot use part or all of your general business credit because of your tax liability limit for the year, carry the unused credit back 1 year. And then to carry back the unused credit, file an amended return for that prior year, or an application for a tentative refund. And you use 1045 or 1139 corporate application for tentative refund, or if you're an individual, you would file Form 1040X. If you have an unused credit after the carryback, carry it forward to each of the 20 years after the year of the credit. Any qualified business credits that are used after the last tax year of that 20-year carry forward period, or at the time an individual dies or another taxpayer such as a corporation or partnership ceases to exist, can be taken as a deduction in the earlier of the tax year following the last tax year of the 20-year carry forward period, or the tax year in which the individual taxpayer dies or the business taxpayer ceases to exist. Now, there are some special rules for eligible small business credits, and it's kind of a nuisance to even discuss this topic because it applied only to 2010. However, if you have an eligible small business credit that is carrying forward from 2010, you need to be able to recognize what made 2010 eligible small business credits special. And as long as we've got that box on Form 3800 for eligible small business credits, we need to understand what they are. And then, of course, we never know when Congress is going to give us another year where we might have one. So let's talk about those briefly just for a page here in the manual, and then we'll continue on. Your general business credit may be limited by the alternative minimum tax. However, for tax years beginning in 2010 only, eligible small business credits were allowed to offset both the regular tax and the alternative minimum tax. Any unused eligible small business credits from 2010 are carried back 5 years and used to offset regular tax and AMT tax in the carryback years. And then, of course, they start to carry forward. So what is an eligible small business? Well, for purposes of the Small Business Job Act of 2010, which is what created the eligible small business credit, an eligible small business is a corporation whose stock is not publicly traded, a partnership, or a sole proprietorship. The following rules and limits apply to the definition of an eligible small business. The average annual gross receipts of the corporation, partnership, or sole proprietorship for the preceding 3 years cannot exceed $50 million. Gross receipts for any tax year must be reduced by returns and allowances made during the year, and any reference to your business also includes a reference to any predecessor of your business. If your business was not in existence for the entire 3-year period, base your average annual gross receipts on the period your business existed. Also, if your business had a tax year less than 12 months, your receipts must be annualized by multiplying the gross receipts for the short period by 12 and then dividing the result by the number of months in the short period. And so ultimately figuring out what you would have averaged for a year if you'd been in business for a year. You should note that except for eligible small business credits, no part of the unused credit for any year attributable to any credit can be carried back to any tax year before the first tax year for which that credit applied. So what it's essentially saying is that only eligible small business credits were allowed a 5-year carryback. Any other type of business was allowed only a 1-year carryback, and other than 2010, any business that meets the definition of an eligible small business only has a carryback for 2010 that goes back 5 years, and only, what is the word I'm using, only applicable against the alternative minimum tax for losses sustained in 2010, or credits that were, not losses sustained, but credits that were generated in 2010. So 2010 is just a very specific window in time that got some tax benefits. So let's take a look at Form 3800 itself. Whenever I teach a class, I like to spend some time analyzing the form. And if you've never analyzed Form 3800, if it's just kind of popped up in your computer software, you've probably gone, whoa, I don't even want to know more about this form because it's got 3 pages and how many lines I can't count. But there's actually a rhyme and a reason to the design of the form. And so I'm going to walk you through how the form is laid out, why it's laid out in the particular way it is, and then from there we'll start looking at the individual credits, and then we'll actually go and show a few illustrations of how to figure a credit and then carry that credit to Form 3800 and then even on to the 1040 form. All right, so let's take a look firstly at Part 1 of Form 3800. You can see we've got Part 1 is comprised of 6 lines. And I've done a little pink box around lines 1 and 2. And the reason I've done that is that those are the most likely boxes that you would need to enter a number on in preparation of a client's tax return. Line 1 is used to enter the amount that is shown on line 2 of Form 3800 from non-passive activities for which box A is checked. And then line 2, enter the amount shown on line 2 of Form 3800 from passive activities for which box B is checked. So we have another part of the form that we fill out, and on that part of the form, we actually check box A or B or some other boxes, and I'll show you that in just a minute. And once you've figured the credit with box A checked or box B checked, you come to a total. Whatever that total is, you bring it over and stick it either on line 1 or line 2. And the line 1 or line 2 is going to indicate whether that credit is due to a passive or a non-passive activity. And it has to, of course, appeared in a certain part of Form 3800 to get entered in Part 1 at all. I'll show you that in just a second. We then move on to Part 2, which is where we figure the allowable credit. And you use Part 2, which is actually basically a page and a half long. You see Part 2 starts on page 1 of the form. It goes to line 17. And then it moves on to page 2 of the form, where it continues on to a total of 38 lines. So when we're talking about the purpose of Part 2, Part 2 is used to determine the amount of your allowable credit. Credits that are entered in Part 1 up here of the form are limited by the alternative minimum tax, which is figured on Form 6251 for individuals and Form 4626 for corporations. Credits that are subject to the alternative minimum tax limits cannot cause net tax to fall below the AMT. Part 2 of the form is used to figure reductions to credits that are limited by AMT. And obviously, it's asking you to go through some fairly complex calculations to determine whether or not you're going to be allowed your full credit, partial credit, or no credit at all because of the alternative minimum tax. Something did happen in 2002 with the Taxpayer Relief Act, not 2002, 2012, with the Taxpayer Relief Act of 2012. That particular act eliminated the alternative minimum tax restriction on personal credits. So previously, when you were figuring your entitlement to credits, say the credit for purchases of a new electric car. Under the personal credits, that credit could be taken away from you by the alternative minimum tax. You go out, you buy this electric car, you think you're going to get a $7,500 credit, you sit down with your tax preparer to figure out your tax, and lo and behold, the AMT took that credit away. Well, the Taxpayer Relief Act of 2012 permanently rescinded that restriction. You could say that basically when you're looking at personal credits, there is no AMT restriction on the ability of a taxpayer to claim a personal credit. However, that elimination of the AMT restriction on personal credits has not impacted business credits, and so individuals and corporations both can find their general business credit being taken away if the taxpayer moves into the AMT zone. And Part 2 of the Form 3800 is used to determine whether or not your general business credit is going to be reduced or eliminated by the AMT. Down here at the bottom, it shows that the carry back and carry forward of unused credit. If you cannot use part or all of your general business credit because your tax liability shown on line 38 is less than the sum of Part 1, line 6, and Part 2, lines 24 and 36, you're going to have to carry the unused credit back 1 year and then begin carrying it forward up to 20 years. To carry back an unused credit, file an amended return, which for individuals would be 1040X, and it's Form 1120X if you're filing a corporate amended return. And generally, if you file an application for a tentative refund, it must be filed by the end of the tax year following the year in which the credit arose. Also, there is a credit that's called the New Hire Retention Credit. It was applicable only for new hires in tax year 2010. And if you claimed the New Hire Retention Credit but could not claim it because your tax liability was too low, and then you had to do carryback, that particular credit could not be carried back 2 years earlier than March 18, 2010. We're now on to Part 3 of the form, and one of the things I have observed and do teach in my classes is that when IRS offers more complex multi-page forms, typically the layout of the forms or the actions you would take to fill out the forms often have you begin on page 2 and then work your way back to page 1. In the case of the general business credit, you actually begin completing the form on page 3 and then work your way back to page 1 and then on to page 2. And here at the top of page 3, it's marked Part 3, General Business Credits for Eligible Small Business Credits. And credits that are limited by the AMT are reported on lines 1A through line 1ZZ down here. Any of the credits that you see listed in this part of the form, which is most of them, can be limited by the alternative minimum tax. Now, before you begin figuring your credit and entering it on line 1A through line 1ZZ, you're going to need to determine whether this credit applies to a passive or a non-passive activity. If you are figuring a general business credit for 2 different activities and one is passive and one is non-passive, then you would need to complete 2 Form 3800s, one for the passive activity and one for the non-passive activity. So you would check box B for a passive activity, figure the passive activity credits on the form. You would then move over to the non-passive activity, figure the non-passive activity credits, and check box A of the form, and obviously fill out a different form. So credits that are limited by the AMT are reported on lines 1A through 1Z. Complete Part 3 before you complete Parts 1 or 2, and prepare a separate Part 3 for each box that is checked. For box A, you check this box if you are claiming a credit that is generated in 2014 for a non-passive activity. Check box B if you are claiming a credit generated in 2014 for a non-passive activity. Check box C or D if you are claiming a carry forward or a carry back credit. And finally, check box G for 2010 qualifying small business credits. So we already talked about line 1A through line 1ZZ. These are credits that are subjected to the alternative minimum tax. You should complete and attach the appropriate credit form that you use to figure your credit during the current year. If you are an individual whose only source of the credit comes from your share of ownership in an S corporation or partnership, you may not need to attach additional forms used to calculate the credit. It may be possible just to attach 3800 to your form because your K1 is showing you the credit amount already. But not always the case. Sometimes you still have to attach 3800 and the accompanying credit form. It just depends. And the form instructions will, of course, tell you. Now, line 2 of Part 3 is the total of all credits that reported in lines 1A through line 1Z. So 1ZZ. So once you have determined the total of all of those credits on line 2, you would then go ahead and enter the total on line 2 and then carry the total to Part 1 on page 1 of the Form 3800 and enter your total there. Line 3 of the form, here in Part 3, refers to Form 8844, which is used to figure the Empowerment Zone and Renewal Community Employment Credit. If you are claiming a credit from a passive activity such as a rental activity or a business in which you did not materially participate, your credit may be limited by the passive activity loss limits. If your credit is limited because of those passive activity loss limits, you're going to have to fill out 8582CR to determine what your limitations are. Moving on to line 4, the good news is that some of the newer credits, some of the ones we're going to be talking about today, actually fall on line 4. And the benefit of having a credit fall on line 4 is that it's not limited by the alternative minimum tax. You can see all of the credits listed on line 1 are subjected to alternative minimum tax, but the credits listed on line 4 are not. The following credits that are not subjected to the AMT limits include the investment credit, the work opportunity credit, the alcohol and cellulosic biofuels credit, the low-income housing credit, the renewable electricity, refined coal, and Indian coal production credit, credit for employer Social Security and Medicare taxes, the qualified railroad track maintenance credit, and the small employer health insurance premiums credit. Having said that, I can tell you that several of these credits have expired at the end of 2013 and are no longer available unless Congress, in its lame duck session, manages to pass something before the end of the year. And so we're going to be talking about a number of credits today that have technically expired. Whether or not they will be extended by last-minute legislation is anybody's guess. I hear people saying that they will likely get extended. I have my own personal opinion, which is who knows. I'm not holding my breath over any of it. But on the off chance that they will be extended, we're going to discuss them, at least in brief, so that you're familiar with them in case they do continue to live on. Finally, on line 5, you total up all of the credits that you entered on line 4, and the total that is on line 5 then is carried to Part 2 to the appropriate line. Credit ordering rule. There's always ordering rules when it comes to credits. When you look at the 1040 form, the ordering rule for claiming credits largely follows the order in which those credits are claimed on the back of the 1040 form. And of course, on the back of Form 1040, the very first credit in line is the foreign tax credit. And then, of course, there's a bunch of other credits that are listed that fall underneath that. It's not a 100% given rule that the credits must be claimed in the order in which they appear on the back of 1040, because there are some exceptions to it, but generally this is the case. When it comes to the general business credit, there are also some ordering rules, and they are as follows. General business credits reported on Form 3800 are treated as used on a first-in, first-out basis by offsetting the earliest earned credits first. Therefore, the order in which credits are used in any tax year is carried forwards to that year with the earliest ones used first, the general business credit that is actually earned in that year, and then the carryback to that year. If your general business credits exceed your tax liability limit, the credits are used in the following order and based on the order shown under order in which credits are used below. Firstly, credits reported on line 2 of all Parts 3 with box A, B, C, and D checked. Credits reported in Part 2 on line 25. The non-eligible small business credits reported on line 5 of all Parts 3 with box A, B, C, and D checked. And finally, eligible small business credits reported on line 6 of all Parts 3 with box G checked. Beyond that, there's also an order in which the credits themselves are used, and this is where I come back to where if you look at the Form 3800 and you look at Part 3 and you see the order in which the credits are listed on the back of that form, kind of, sort of, that's the order in which the credits are used up, but not entirely. There is not an exact correlation. There's almost a correlation, but some of the credits, the order in which they are used, differs slightly from the order in which they appear on the form. And so the order in which the credits are used actually is shown here in the manual. Firstly, we have the investment credit. And I did want to point out that a number of the credits that I've listed here have little asterisks next to them. If the credit has an asterisk next to it, it is a credit that has expired as of the end of 2013, that no longer is valid for 2014 except under carry forward provisions, and it's basically going to be a matter of wait and see as to whether any of these credits are resurrected. We're going to talk about most of these credits during today's class, some in very little detail, others in substantial detail, so I'm not going to read them all to you here. Let's move on to Form 3800 General Business Credits and start talking about those specific credits in order that they appear on the form. Following are some brief and more detailed descriptions of the business credit forms or the general business credit forms. And all of these credits that I'm about to discuss appear on Form 3800. At the very end of today's class, we're actually going to talk about another type of credit that is not claimed on Form 3800, and it is a refundable credit. But all of the non-refundable credits that I'm going to talk with you about today are claimed on Form 3800. Most credits are claimed on lines 1A through 1ZZ of Part 3, and credits that are claimed on line 1 are, of course, subjected to alternative minimum tax restrictions. The first credit in line is on line 1A of the form. It is the investment credit. The investment credit consists of the Rehabilitation, Energy, Qualifying Advanced Coal Project, Qualifying Gasification Project, Qualifying Advanced Energy Project, and Qualifying Therapeutic Discovery Project credits. Obviously, that's a very specific range of businesses out there that qualify for it. Odds of any particular person taking my class running into it are fairly remote. But if you are working with a client who benefits from this credit, the place that you go to learn more about it and how to compute it is the instructions for Form 3468. So as a general rule, the information that I'm giving you in today's class came from two sources: the instructions for the IRS form and other IRS website links. So when I'm putting together the content for today's class, you don't typically run across IRS publications that are devoted to 3800. For example, the IRS does have a complete publication plus very detailed computational instructions for figuring the foreign tax credit, but there is no Form 3800 publication. So when you're left with trying to figure any of the general business credits, the starting point is the instructions for the particular form that needs to be filled out to claim a particular credit. And if you need more than that, ultimately you're left reading the code itself. Sometimes there's some IRS revenue procedures that have been written, and in addition there are often pages on IRS's website that offer more information again. But it's basically a research game of trying to figure out more information if you need it. And then again, the starting point is the instructions for the form. The next credit that we're going to talk about is the credit for increasing research activities, which is figured on Form 6765. This credit applies to expenses paid or incurred for qualified research. Research must be undertaken for discovering information that is technological in nature, and its application must be intended for use in developing a new or improved business component of the taxpayer. In addition, substantially all of the activities of research must be elements of a process of experimentation relating to a new or improved function, performance, reliability, or quality. This is one of the credits that has expired for tax years after 2013 unless it is extended by future legislation, and there is some belief out there that that will in fact happen. Perhaps not this year, maybe it'll come back for 2014, who knows? Or 2015, who knows? The research credit generally, however, is not allowed for the following types of activities: research conducted after the beginning of commercial production, research adapting an existing product or process to a particular customer's need, duplication of an existing product or process, surveys or studies, research relating to certain internal use computer software, research conducted outside of the United States, Puerto Rico, or a U.S. possession, research in the social sciences, arts, or humanities, or research funded by another person or governmental entity. The next credit we're going to look at is the low-income housing credit. This is one of the credits that has expired. This credit generally applies to new qualified low-income housing buildings that are placed in service after 1986 but before 2008. It is expired. It just didn't expire in 2013. And generally, this is taken over a 10-year credit period. Next, we have the Disabled Access Credit, and this one really has not expired. This credit has been around for a number of years and doesn't show any sign of ever going away on us. And so because of the fact that it is a permanent credit and because of the fact that it actually is specifically designed for small business, it is one of the credits that you're more likely to run across when working with your tax clients. If you make your business accessible to persons with disabilities and your business is an eligible small business, you may be able to claim the Disabled Access Credit. If you choose to claim the credit, you must reduce the amount you deduct or capitalize by the amount of the credit that you are claiming. Eligible small business defined for purposes of the credit. An eligible small business is any business or person that has gross receipts for the preceding tax year that did not exceed $1 million or had no more than 30 full-time employees during the preceding tax year and elects by filing Form 8826 to claim the Disabled Access Tax Credit for that year. So for purposes of the definition of an eligible small business and a disabled access improvement, gross receipts are reduced by returns and allowances that are made during the year. An employee is considered to be full-time if employed for at least 30 hours per week for 20 or more calendar weeks during the tax year. And all members of the same controlled group and all persons under common control generally are considered to be one person. So let's take a look at what constitutes an eligible access expenditure. For purposes of the credit, eligible access expenditures are amounts paid or incurred by the eligible small business to comply with applicable requirements under the Americans with Disabilities Act that became law back in 1990. Eligible access expenditures include amounts that are paid or incurred to remove barriers which prevent a business from being accessible to or usable by persons with disabilities. The facility itself must have been placed in service prior to November 6, 1990. So essentially what this is saying is if you have a new construction building and you do some disabled access improvements to it, that new building is not going to qualify. The access to that building will not qualify because the building itself should have been ADA compliant when it was built. Really, this law was meant for those grandfathered buildings that were never built ADA compliant before the law came into place, and to give eligible small business owners, an incentive to make them ADA compliant without requiring them to make them ADA compliant. But newer buildings should have been built ADA compliant from the get-go, and that's why the credit doesn't apply to them. Number 2, to provide qualified interpreters or other methods of making audio materials available to hearing impaired individuals. Also, to provide qualified readers, tape texts, and other methods of making visual materials available to individuals who have visual impairments, or to acquire or modify equipment or devices for individuals with disabilities. So in other words, if you are spending money to equip your building or equipment to accommodate people with disabilities, you may qualify for the credit. In the case of the building must have been placed in service prior to November 6, 1990. These others do not have that requirement. So for example, if you were making modifications to a vehicle to service individuals with disabilities, that vehicle could be a modern purchased vehicle, and it doesn't need to be one that's 20 plus years old. The expenditures must be reasonable and necessary to accomplish the previously mentioned purposes, and eligible access expenditures must meet the standards that are issued by the Secretary of the Treasury as agreed to by the Architectural and Transportation Compliance Board and set forth in the regulations. Now, this particular deduction that I'm about to talk to you about is not a part of the Disabled Access Credit. However, the types of improvements that we talk about in this particular description can qualify for the Disabled Access Credit. It's just that there is a Disabled Access deduction that can be claimed by a business in addition to the credit. And when you're getting into larger businesses that are not eligible for the credit, they may still be able to claim the deduction. So what is the Disabled Access Deduction? It is a deduction that a business can claim of up to $15,000. So in addition to the disabled access credit, you may be able to claim a deduction for the cost of certain improvements to property that remove barriers to access for the disabled. But unlike the credit, the deduction is not restricted to qualifying small businesses. For disability, for an individual who is disabled, this means a physical or mental impairment that substantially limits one or more major life activities, a record of such impairment, or being regarded as having such an impairment. Barrier removal costs. The cost of an improvement to a business asset is normally a capital expense. However, you can elect to deduct the cost of making the following property more accessible to and usable by those who are disabled or elderly, including a facility or a public transportation vehicle. You must own or lease the facility or vehicle for use in connection with your trade or business. So what is a facility? Well, a facility is all or any part of a building, structure, equipment, road, walkway, parking lot, or similar real or personal property. Deductible facility costs. The following is a list of some of the architectural barrier removal costs that can be deducted. Ground and floor services, walks, parking lots, ramps, entrances, doors and doorways, stairs, floors, toilet rooms, water fountains, telephones, elevators, controls, signage, alarms, protruding objects, and symbols of accessibility. So essentially, the particular items that are described here are eligible to be claimed as a deduction under this description here, disabled access deduction. But these also are the types of improvements that can qualify for the disabled access credit. So it just depends on how the business wants to claim the expense, either as a credit or as a deduction, in some cases possibly a little bit of both. Public transportation vehicle. A public transportation vehicle is a vehicle that provides transportation service to the public, including service for your customers, even if you are not in the business of providing transportation services. And right here I have an image of a van that you can see has had a wheelchair ramp placed into it. And this would be a good example of the type of accessibility improvement a business owner might make. Deductible transportation barrier removal costs. Deductible costs can include rail facilities, buses, and rapid and light rail vehicles, and other barrier removals. To be deductible, expenses of removing any barrier not covered by the above standards must meet all three of the following tests. Firstly, the removed barrier must be a substantial barrier to access or use of a facility or public transportation vehicle by persons who have a disability or are elderly. The removed barrier must have been a barrier for at least one major group of persons who have a disability or are elderly, such as people who are blind, deaf, or wheelchair users. The barrier must be removed without creating any new barrier that significantly impairs access to or use of the facility or vehicle by a major group of persons who have a disability or are elderly. Non-deductible costs. You cannot deduct any costs that you paid or incurred to completely renovate or build a facility or public transportation vehicle or to replace depreciable property in the normal course of your business. Deduction limit. The most you can deduct as a cost of removing barriers to the disabled and the elderly for any tax year is $15,000. However, you can add any costs over this limit to the basis of the property and depreciate these excess costs. Partners and partnerships. The $15,000 limit applies to the partnership and also to each partner in the partnership. A partner can allocate the $15,000 limit in any manner among the partners' individually incurred costs and the partner's distributive share of the partnership costs. But if the partner cannot deduct the entire share of the partnership costs, then the partnership can add any costs not deducted by that partner back into the basis of the improved property. A partnership must be able to show that any amount added to the basis was not deducted by the partner and that it was over that partner's $15,000 limit as determined by that partner. If the partnership cannot show this, then it is presumed that the partner was able to deduct the distributive share of the partnership's full costs. So it's kind of a mouthful. I had to read it several times before I understood it, and then I thought, well, let's create an example. So here we have an example where we have a partner who is not able to claim a full deduction from his share of partnership expenses flowing through to him on his K-1. Luke had income from two businesses during the year as follows. His distributive share of a partnership's deductible expenses for the removal of architectural barriers totaling $12,000. and $13,000 of similar expenses in his sole proprietorship. Well, 12 plus 13 is clearly more than 15. You get 25, so he's going to be limited. Luke has elected to deduct $7,000 of expenses relating to his sole proprietorship, and the remaining $8,000 of the $15,000 limit is applied to his share of the partnership expenses. So Luke can add the excess $6,000, because up here the total is 12 coming through the partnership, but he's only going to be claiming 6. So Luke can add the excess 6 of his own expenses to the basis of the property used in his sole proprietorship business. If the partnership can show that Luke cannot deduct $4,000, that's $12,000 minus the $8,000 he is claiming on the partnership, then the partnership can add that unused $4,000 back into the basis that the partnership has in its property. Qualifying standards, you can deduct the cost as a current expense only if the barrier removal meets the guidelines and requirements that are issued by the Architectural and Transportation Barriers Compliance Board under the ADA of 1990. You should visit the following websites for additional specifications and information. And so this is one of the things that I run across when I'm researching exactly what these rules mean. They're basically saying, well, you have to go to the websites of these different organizations to further read definitions if you are at all concerned about whether or not a particular expense is going to qualify as a disabled access improvement that could be eligible either for the disabled access credit or the disabled access improvement deduction. So any questions, I recommend you go follow the links here. So how do you make the election? If you elect to deduct costs for removing barriers to the disabled or elderly, claim the deduction on your income tax return for the tax year the expenses were paid or incurred. Identify the deduction as a separate item. The election applies to all of the qualifying costs you have during the year up to the $15,000 limit. If you make this election, you must maintain adequate records that support your deduction. So when do you make the election? Well, for your election to be valid, you must generally file your return by its due date, including extensions. However, if you timely filed your return for the year without making the election, you can still make the election by filing an amended return within 6 months of the due date of the return, including extensions, and then clearly indicate that the election is being made on the amended return by writing filed pursuant to section 3019100-2. File the amended return at the same address you filed the original return, and the election, once it's made, is irrevocable after the due date, including extensions of your return. So let's take a look at how all of these rules that I just gave you can be summarized and placed to work for us on a particular illustration. So I created a comprehensive illustration here of figuring the disabled access deduction and the disabled access credit. The character in this story is named George Burns. He is age 50 and is a single filer. He owns and operates a sole proprietor business called Larkspur Home for the Elderly, which provided his sole source of income for the year. George operates his business from a residential home that was originally built in 1960. And during the year, George made the following disabled access improvements to the business premises and the transportation vehicles. He built a wheelchair ramp to the building costing $30,000 and put a wheelchair lift into the Chevy van at a cost of $5,000. So his total disabled access improvements for the year total $35,000. George's P&L for Larkspur Home for the Elderly shows the following income and expenses for the year. His income is $300,000, and he had all of the following expenses. And you can see that among these expenses, he's got the wheelchair lift and the wheelchair ramp. Well, we know he cannot deduct those items outright. They're going to be considered to be capitalized expenses, so they need to be placed on his depreciation schedule. But he is eligible to claim a disabled access deduction of up to $15,000, and he's also eligible to claim a credit for disabled access improvements. So let's work through and see how we do this for him. George has elected not to claim any Section 179 depreciation deduction for 2014, and other than the disabled access improvements, he has no other depreciation deductions for the year. He would like to claim a deduction for the disabled access improvements and the disabled access credit. Prepare his return as follows. We're going to complete Form 8826 to figure the amount of the disabled access credit that George is allowed to claim, and then we reduce his basis in the wheelchair ramp and the wheelchair lift by the amount of credit that he claims. So here we have Form 8826. It's actually one of the simpler forms out there at only 8 lines long. On line 1, we enter the total cost of the eligible access expenditures, which is $35,000. We then subtract out this $250 rule. It simply says that you cannot claim the credit if your expenses are not over $250. So we subtract out $250, and we're left with $34,750. The maximum amount of qualifying expense for purposes of figuring the credit is $10,000. So we're going to enter the smaller of line 3 or 4, and in this case, the smaller line is line 4. And then, of course, the credit is 50% of the qualifying expense. The qualifying expense is $10,000, and the credit is $5,000. We're going to take this credit amount and enter it in Part 3 of Form 3800 on line 1E, and you can see that because it's being entered on a line 1 in Part 3, it means that the disabled access credit can be limited by the alternative minimum tax. Is that going to mean anything for George? Yeah, it will. All right, so let's take a look at George's Schedule C. On his Schedule C, we're showing the gross receipts from the business. We're listing some of the expenses, actually all of the expenses I gave for you on his little P&L, with the exception, of course, being the disabled access improvements, because those have to be capitalized and claimed specifically through depreciation or the credit. So those particular items actually end up being claimed on line 13 and on line 27. And in order to get to the amount that we enter on line 27, we actually have to go to page 2 of Schedule C. And on page 2 of Schedule C, you can see that we are claiming a $15,000 deduction that's called the Disabled Access Deduction. And so that deduction is being claimed, but then what we're left with is the basis in those access improvements is going to be reduced by the amount of credit he's claiming and by the amount of deduction he's claiming. We then figure depreciation on the residual balance of basis that's left. When we're finished figuring what that amount is, it comes out to $982. So let's take a look at his 4562 where we did that figuring. Firstly, we have the wheelchair lift for the van. The cost of the lift was $5,000. We've claimed a 50% credit against that cost. That leaves us with a $2,500 remaining basis in the wheelchair lift. We've done 7-year depreciation with 200% declining balance and applying a half-year convention, and that gives us a $357 deduction. We then move over to the wheelchair ramp. The cost of the ramp was $30,000. We're going to claim a deduction of $15,000, and then we're also claiming another $2,500 of disabled access credit, leaving us with a depreciable basis of $12,500. We're going to apply a 150% declining balance and a half-year convention. When we finish doing our math, we end up with $625. $625 plus $357 is $982. That is the amount of the depreciation deduction that we're claiming on Schedule C. We now move on to Part 3 of the General Business Credit Form. This particular part needs to be filled out before we can fill out page 1 and 2 of Form 3800. You can see up at the top we checked box A, General Business Credit from a non-passive activity, and we've entered the amount of the credit on column C, $5,000. We follow that total down to the bottom of the form on line 6, and then we move over to page 1 of the form. On line 1, we enter $5,000. And then it's time to begin figuring his tax. Well, to figure Part 2 of Form 3800, we have to go all the way back to the 1040 form and figure his income tax, and then we have to figure Form 6251 for his alternative minimum tax. So let's go take a look at his 1040 form. This is George's 1040 form right here. And you can see on line 12, we've entered the net income from the business. We move over to line 38. We have his adjusted gross income. We claim a standard deduction. We claim a personal exemption. We end up with taxable income of $163,160. When we go to the tax rate schedules and figure his tax, we end up with $38,861 of income tax. But we're not done. Now we have to go up and complete Form 6251 to figure what his alternative minimum tax will be. We begin by figuring his alternative minimum taxable income. We then enter his exemption deduction. His exemption deduction is limited by his income, so we have to figure the line 29 worksheet to figure out what his allowable exemption deduction is. It's $37,832. We then go through the computations to determine that his alternative minimum tax for the year is $36,228. Well, that's less than the income tax showing on his 1040, so he doesn't actually owe any alternative minimum tax. His alternative minimum tax being entered on line 35 is 0. However, the difference between line 34 and line 33 is clearly not $5,000, and because it's less than the amount of the disabled access credit that he's claiming, we automatically know his disabled access credit is going to be limited. In this case, the difference between line 33 and line 34 is $2,633. Ultimately, we're going to move back over to page 1 of Form 3800, and in Part 2, we're going to determine that his disabled access credit is going to be limited to this difference of $2,633. So we go back up to page 1 of Form 3800. We enter his federal tax from his personal tax return. We then enter his alternative minimum tax from Form 6251. Ultimately, when we're all done with this, we end up showing that his credit is going to be limited to $2,633, and the instructions tell you to then take that and enter it on the appropriate form. In this case, the appropriate form is his 1040 form. So we're just going to move over to Form 1040 onto page 2, and you can see down here on line 54, we check box A for Form 3800 and enter $2,633. So essentially, George figured a nice $5,000 credit for the disabled access improvements he made, but he's only going to be allowed slightly over half of his credit for the year. This particular credit is allowed only for the sale of electricity, refined coal, or Indian coal that is produced in the United States or U.S. possessions from qualified energy resources at a qualified facility. This is another one of the energy credits that has expired for tax years after 2013 unless it is extended by future legislation. Next up, we have the Indian Employment Credit. This credit also has expired unless it's extended and is claimed on Form 8845. The credit applies to the part of qualified wages and health insurance costs up to $20,000 per employee that you incurred during a year that is more than the sum of the comparable costs you or your predecessor paid or incurred during calendar year 1993. The employee must be an enrolled member or the spouse of an enrolled member of an Indian tribe, and the employee must perform substantially all of his or her services within the Indian reservations while living on or near the reservation. Next up, we have the Orphan Drug Credit claimed on Form 8820. This credit applies to qualified expenses incurred in testing certain drugs for rare diseases and conditions. The credit is 50% of qualified expenses, and these expenses may have to be reduced by the amount, if any, of expenses taken into account in figuring the amount of the allowable qualifying therapeutic discovery project grant or credit that was figured on Form 3468. The credit may have to be reduced by the amount, if any, of the credit for employer differential wage payments from Form 8932 as well. Next up, we have line 1I, where you figure the new markets credit from Form 8874. This credit is for qualified equity investments made in qualified community development entities. It is another one of the credits that is expiring after 2013 unless extended. Line 1J, credit for small employer pension plan startups. Here's one that has not gone away, is still around, and you might even have a business that qualifies for it. This credit applies to pension plan startup costs if you begin a new qualified defined benefit or defined contribution plan, including a 401k plan, a simple plan, or simplified employee pension. You can receive a credit of up to 50% of the qualified startup costs paid or incurred during the year. The credit is limited to $500 per year for the first credit year and each of the following tax years. Next up, we have the credit for employer-provided child care facilities. This credit applies to the qualified expenses you paid for employee child care and qualified expenses you paid for child care resources and referral services. If you have a client that has paid for child care facilities and services, you can find out more about this particular credit on Form 8882. Next up, we have the biodiesel and renewable diesel fuels credit. This credit consists of the following 5 different credits: the biodiesel credit, the renewable diesel credit, the biodiesel mixture credit, the renewable diesel mixture credit, and the small agro biodiesel producer credit. Again, it's an energy credit, and it has expired as of 2013 unless it gets extended. Number 1M, low sulfur diesel fuel production credit. This credit is for the production of low sulfur diesel fuel by a qualified small business. We then have the distilled spirits credit. This credit is available to distillers and importers of distilled spirits and eligible wholesalers. Generally, the credit for the tax year is figured by multiplying the number of cases of bottled distilled spirits purchased or stored during the tax year by the average tax financing cost per case for the most recent calendar year ending before the beginning of the tax year. We then have the non-conventional fuel source credit. This credit is for qualified coke and coke gas that you produced and sold to an unrelated person during the year. This is another credit that is expired for years after 2013 unless it is extended. Energy efficient home credit. This credit is available for eligible contractors of certain homes sold for use as a residence. Another credit that is expired after 2013 unless it is extended, as is the case with the energy efficient appliance credit, which was available for manufacturers of qualified energy efficient appliances. Next up, we have the alternative motor vehicle credit claimed on Form 8910. This credit has been around for a long, long time, or the form itself has been around for a long, long time, and essentially it was implemented to accommodate a variety of different applications where the credit could be claimed. And most of these applications have actually expired, but there are still reason for this form to continue existing. With the exception of the qualified fuel cell vehicles, the alternative motor vehicle credit has expired for any vehicle purchased after 2010. But if you happen to purchase a qualified fuel cell vehicle, it still is in place for 2014 even. As you will see, though, it doesn't appear that there's many manufacturers making a qualified fuel cell vehicle that could even be purchased in 2014. This is the list of qualified fuel cell vehicles I could come up with. A qualified fuel cell vehicle is a new vehicle that is propelled by power derived from one or more cells that convert chemical energy directly into electricity by combining oxygen with hydrogen fuel. The amount of the credit for a qualified fuel cell motor vehicle is based on the weight of the vehicle when the vehicle is placed in service. The purchaser may claim a credit for the certified amount of the fuel cell vehicle if it is placed in service by the taxpayer after 2005 and before the end of 2014. So after 2014, this particular credit will be completely gone. But as you can see here, the last manufactured year of a vehicle is 2012 for both Mercedes and Honda. So it's possible someone has purchased a vehicle in 2014 that was manufactured under the 2012 label, and if they did, they may qualify for this particular credit. Next up, we have line 1S for claiming the credit for alternative fuel vehicle refueling property on Form 8911 for tax years 2006 through 2013 and also for 2014 for hydrogen refueling property. Section 30C allows taxpayers to claim a credit for the cost of installing clean fuel refueling property that is used in a trade or business or installed in the taxpayer's residence. The credit is the smaller of 50%, or in the case of hydrogen refueling property, 30% of the property's cost. The limit is $50,000 for business property installations, or $200,000 for hydrogen refueling, and $2,000 for personal residence installations, but only $1,000 for hydrogen refueling property. Then we move on to line 1U, the mine rescue training credit. This credit applies to the training program costs you pay or incur for certain mine rescue team employees. This is another credit that is expired for tax years after 2013. Agricultural chemicals security credit. This credit is for qualified agricultural chemicals, security costs paid or incurred by eligible agricultural businesses. All of the costs must be paid or incurred to protect the specified agricultural chemicals at a facility. Without being an expert on this particular topic, agricultural fertilizers and other agricultural chemicals can be used for purposes other than their intended purpose, and this law was created to encourage farmers that are storing these chemicals to protect them from theft. And so this particular credit has expired after 2012, however. Unless we see some future legislation extending it, it's gone. Haven't had a terrorist attack involving fertilizer for a while, so I guess we're waiting for that to happen before it's brought back. 1W, credit for employer differential wage payments as an incentive to continue paying wages to an employee performing services on active duty in the United States Armed Forces. An eligible small business can claim a tax credit of 20% of up to $20,000 of differential wage payments paid to each qualified employee during the year. So essentially what happens is an employee is a member of the reserves. He is working for a particular employee, he's called up to the reserves, and when he goes to serve his country or her country, takes a pay cut. And some employers actually bridge that loss in wages and continue to pay the difference to that particular employee while they're serving. And under the differential wage payment credit, an employer who did bridge that gap could claim a credit of 20% of up to $20,000 of the differential wages that they paid to a particular employee. A qualified employee is an employee of an eligible small business employer for the 91-day period immediately preceding the period for which any differential wage payments is made. Eligible small business employer means any taxpayer that employed an average of fewer than 50 employees on business days during the tax year and under a written plan of the employer provides eligible differential wage payments to every qualified employee of the employer. Differential wage payment. To be considered a differential wage payment, the payment must be paid after 2008 and before 2014 and meet the following requirements. The payment is made by an eligible small business employer to a qualified employee for any period during which the employee is performing service in the U.S. Armed Forces while on active duty for a period of more than 30 days, and the payment represents all or a portion of the wages the employee would have received from the employer if the employer were actually working for the employer and not called to active duty. Eligible differential wage payments. The eligible differential wage payments are the total differential wage payments paid by the employer to the employee for up to $20,000 for the tax year. Claiming the credit, you claim the credit by completing Form 8932 and then, of course, carry it over to line 1W of Form 3800 and then on to the 1040 or the corporate return that you are preparing. 1X is used to figure and claim the carbon dioxide sequestration credit. Figure the credit on Form 8933 and then carry it over. The credit is for qualified carbon dioxide that is captured at a qualified facility and disposed of in a secure geological storage or used in a qualified enhanced oil or natural gas recovery project. Only carbon dioxide captured and disposed of or used as a tertiary injectant within the United States or U.S. possession is taken into account when figuring the credit. Now we're moving on to the qualified plug-in electric drive motor vehicle credit. It's one of the only energy credits that's still around there and still available, and still available enough that I think a good number of people are claiming it. Depending on where you are, the type of business you have, this credit could be coming up. Not very often, but it can be coming up. The credit is available if you placed into service for business or personal use a qualified plug-in electric drive motor vehicle in 2014. Generally, you can rely on the manufacturer's certification that the vehicle qualifies for the credit. How much is the credit? Well, it varies anywhere from $2,500 to $7,500 depending on the vehicle that you purchase, and really it has to do with how far that vehicle will travel on a charge. Some vehicles travel relatively short distance on a charge, and so they get a smaller credit than other vehicles that will go a longer distance on a charge. So what is a qualified vehicle? Well, a qualified vehicle is a motor vehicle that the original use of which starts with U and has 4 wheels. It can have more than 4 wheels, but it has at least 4. Is acquired for your use or lease and not for resale. Is made by a manufacturer. Is manufactured primarily for use on public streets, roads, and highways, has a gross vehicle weight rating of less than 14,000 pounds, is a motor vehicle for purposes of the Clean Air Act, is propelled to a significant extent by an electric motor that draws electricity from a battery that has a capacity of at least 4 kilowatt hours and is capable of being recharged from an external source. And I have a little asterisk here next to the word note, because up here it says the vehicle is acquired for your use or lease. And what is meant by that is that you purchase the vehicle either to use it for yourself or to be the owner of a vehicle that you are leasing to someone else. What that means is that if you go to a car dealership and you decide to lease a new electric car, you're not going to be eligible for the credit because you're not the owner of the car. When you sign the lease, the owner of the car is going to be the bank that is financing that lease. And so ultimately the credit will be claimed by whoever the actual true owner of that car is, and not the person who signed on the lease to rent it or lease it for a 2 or 3 year period. I have some images up here of some of the vehicles that qualify for this particular credit. Zenith is a manufacturer of vans, and this is their van. It'll go, I think, 120 miles on a charge. We have the Chevy Volt, which is a hybrid vehicle. It has a gasoline generator that kicks in when the battery itself runs dry. It'll go about 40 miles on a charge. We then have a Toyota vehicle, and of course we have the Nissan Leaf down here. But there are a number of other vehicles, and I'll show you the list in just a second. Phase out of the credit. The credit begins to phase out when a manufacturer has essentially sold 200,000 vehicles, and no manufacturer has come close to that 200,000 threshold yet. So no vehicles or manufacturers are phasing out as of yet. Here is a list of the vehicles that are approved for 2014. You can check at any time to see if any new vehicles have been added to IRS's website by clicking on the URL that you see on this particular page. And you can see how the credit amount varies according to the vehicle a particular manufacturer has made. Here we have an America Honda Accord plug-in hybrid. The credit is $3,626. Without knowing any more about the vehicle, I'm figuring it's getting around 20 miles on a charge. Because its credit is half that of the Chevy Volt, which is the full $7,500. Ford Focus has a $7,500 credit, but the Ford C-Max Energy and Ford Fusion Energy are only $4,000. Mercedes has manufacturing some vehicles that qualify for the credit. Mitsubishi, Nissan Leaf was one of the first, it's still there. Porsche has a couple of vehicles that qualify for reduced credits. Then of course there's the famous Tesla that's manufactured, a luxury car. And then we have that Toyota Prius plug-in. Only a $2,500 credit goes with it. That tells you that although it is a plug-in vehicle, it doesn't go very far on electricity only. Then we have the Toyota RAV, $7,500, a WeGo Life electric vehicle, and finally the Zenith electric van that you saw in that picture, $7,500 credit. How do you claim the credit? Well, you obviously need to determine that it is a qualifying vehicle, and if it is, then you fill out Form 8936. Moving on, line 1Z is the Qualified Plug-in Electric Vehicle Credit. This credit originally applied only to vehicles acquired after February 17, 2009, before January 1, 2012. However, the Taxpayer Relief Act of 2012 extended the credit through 2013. As of 2014, it has expired, and Form 8834 is used to claim any credit that is being carried forward. The credit is equal to 10% of the cost of a qualified plug-in electric vehicle and is limited to $2,500. Unlike the credit on the preceding page that's claimed on 8936, this credit actually applied to smaller 2- and 3-wheeled vehicles, and it's basically completely expired except for carry-forward provisions. Line 1AA is the new hire retention credit. That particular credit was available to new hires that were made in the year 2010 at basically the height of the recession, when unemployment was very high. It's eligible for carry forward of up to 15 years, so you may still see it being claimed by some employers, but only as a carry forward. We then have the investment credit. The rehabilitation and energy credits are claimed under the investment credit rules, Form 3468. We then have the work opportunity credit, and the work opportunity credit is a federal tax credit that provides private sector businesses with an incentive for hiring individuals from target groups that have consistently faced significant barriers to employment. This particular credit was well in play during the recession, and it kept expiring and was then extended, but it has finally expired as of the end of 2013 unless it is extended again. Unlike other credits, the work opportunity credit is not just something at the last minute you determine your client can claim it and slap it on the return. If an employer qualifies for the work opportunity credit, they actually have to hire an individual from a targeted group and go through an application process early on during the hiring phase. If your client did not do that, then clearly they're not going to be able to claim the credit even if the credit hadn't expired. So There goes that one. Then we move on to line 4C, alcohol and cellulosic biofuels credit. This credit consists of alcohol mixture credit, alcohol credit, small ethanol producer credit, and the cellulosic biofuel producer credit. You claim the credit for the tax year in which the sale or use occurs, and like most of the other energy credits, this one has expired unless it's extended. We then move on to the low-income housing credit. This general business credit is allowed for each new qualified low-income building that is placed in service after 2010. The credit is generally taken over a 10-year period. The portion of the low-income housing credit is not limited by tentative minimum tax. And you can see actually all of these particular credits that we start on line 4A through 4D that we've covered are not limited by AMT because they're not anywhere on line 1. Qualified low-income housing project. Let's move on to the renewable electricity, refined coal, and Indian coal production credit. Has to do with energy, so you bet it has expired. If it is resurrected, the credit is allowed only for the sale of electricity, refined coal, or Indian coal produced in the United States or a U.S. possession from a qualified energy resource at a qualified facility during the 4-year period beginning on the date that the facility was placed in service. Finally, on line 4F, we've got a credit that hasn't expired and is actually a fairly common credit if you're dealing with any tax clients who own restaurants. This is a credit that you should be really familiar with, or you could be costing your clients some money. The credit is called the Credit for Employer Social Security and Medicare Taxes Paid on Certain Employee Tips. You figure the credit on Form 8846. The credit is generally equal to the employer portion of Social Security and Medicare taxes paid on tips received by employees of a food and beverage establishment where tipping is customary. The credit applies regardless of whether the food is consumed on or off your business premises. Claiming the credit will file Form 8846 to figure and claim the credit if you meet both of the following conditions. Number 1, you had employees who received tips from customers for providing, delivering, or serving food or beverages for consumption if tipping of employees for delivering or serving food or beverages is customary. And during the tax year, you paid or incurred employer, Social Security, and Medicare taxes on those tips. Well, of course, employees are required under the law to report their tips received to their employers, specifically so that employers can do the tax payments and withholdings from employee wages. And this particular credit can only be claimed if that reporting process is going on. Because in order to claim the credit, you have to track the tips being received, you have to pay the taxes that are owed on those tips, and then follow through and claim the credit. So how is the credit figured? Well, generally the credit equals the amount of employer Social Security and Medicare taxes paid or incurred by the employer on tips that were received by the employee. The credit is reduced, however, in the following situations. The amount of tips for any months that are used to figure the credit must be reduced by the amount by which the wages that would have been payable during that month at $5.15 an hour exceed the wages, excluding tips, that were paid by the employee during that month. I'll show you how that rule works in just a second. And then the combined wages paid to an employee, if they exceed the Social Security limit, obviously you can't claim a credit for wages that exceed that amount. Not too common with people working in restaurants anyway to exceed that amount, although I suppose it's theoretically possible. Now, let's take a look at this rule about if the wage earned by the employee is less than $5.15 per hour. An employee worked 100 hours and received $450 in tips for October 2014. The worker received $375 in wages excluding tips at a rate of $3.75 an hour. Believe it or not, there are some states where the minimum wage is so low that it is possible to only earn $3.75 an hour. If the employee had been paid $5.15 an hour, then the employee would have received wages excluding tips of $515 an hour. So the employee received $375 in wages and $450 in tips, and the amount of credit that the employer is going to be eligible for is essentially going to be $515 subtracted from $375 plus $450. So for credit purposes, the 450 tips is reduced by $140, the difference between $515 and $375, and only $310 of employee tips for the year is taken into account. So let's take a look at how we go about preparing Form 8846. We'll look at its component parts, and then I have another illustration to show you of how we prepare the return for this particular type of credit, flow it through to the taxpayer, and fill out Form 3800 as well. Certain food and beverage establishments use Form 8846 to claim this credit for Social Security and Medicare taxes that were incurred by the employer on tips collected by employees. You can claim or elect not to claim the credit anytime within 3 years from the due date of your return on either your original or an amended return. On Form 8846, Line 1, enter the tips that were received by the employee for services on which you paid or incurred employer Social Security and Medicare taxes. You should include tips received from customers for providing, delivering, or serving food or beverages for consumption if tipping of employees is customary. So the amount of tips received by employees is entered on Line 1. Then on Line 2, you enter tips that are not subject to the credit, and that's essentially any tips that really bridge that gap between $5.15 an hour, which is the minimum wage for purposes of figuring the credit, and the actual minimum wage received by that particular worker. Then on Line 3, you do a subtraction. You take Line 2 from Line 3 and enter the total on Line 3. And in most cases, Line 3 and Line 1 are the same number because Line 2 is blank, and you'll see that in the illustration I give you today. We then multiply Line 3 by 7.65% unless you had employees who have wages that exceeded $117,000 for the year, and you then enter that total on Line 4. On Line 5, if the activity is a passive activity, then enter the amount from Line 6 that is a passive activity, and on Line 6, enter the total amount of credit for the employer Social Security tips that you have figured. So let's take a look at how we fill out that form with a comprehensive illustration. In this illustration, we have a character named Sam Bear, who is the sole shareholder in the Bear House, Inc., which is an S corporation. The Bear House operates a restaurant in Spokane, Washington, and the Bear House had the following income and expense items that were reported on Form 1120S for the year. We have income of $400,000. We also have some cost of goods sold computations here. The cost of labor is $80,000. The cost of purchases is $60,000. When we bounce down here to the W-3, and whenever you're dealing with the employer credit for payroll tax on tips, actually anytime you're preparing an S corporation or any kind of business tax return for an individual or business that has employees, you should be asking to see the W-3 anyway. Important stuff is on the W-3, and it's good to balance the return to the W-3 because very often the bookkeeping records of the small business owner don't jive at all with the W-3. The most common reason I see for this is that the small business owner will enter bookkeeping entries for the amount of checks that have cleared by an employee. So if they make gross wage payments to an employee of $3,000 for the month, the net check to that employee after all the taxes are held out might only be $2,000. And so the employer will record $2,000 as a payroll expense when in fact the payroll expense should be $3,000. But they don't know this, so they're just recording the actual amount of the check instead of the total amount of gross pay before withholdings. So I like to balance my clients' bookkeeping against the W-3 to make sure that they are relatively close, as they should be. In this case, you'll see that we have $100,000 of wages paid, and we have a cost of labor up here of $80,000 of wages. Where's the missing $20,000? Well, the missing $20,000 is down here because Sam Bear actually took an owner wage of his own of $20,000. That's where we're getting $100,000, $20,000 to Sam and $80,000 to his workers, and the amount that he paid to his workers is being figured as a cost of goods sold item. Payroll taxes that he paid on those wages are shown down here. The payroll tax is $76.50. That is his share of the payroll taxes paid out, but he also had other taxes paid during the year that are not payroll taxes totaling $4,350. So the total tax expense he has for the year that he claimed on his tax return is $12,000. He then has accounting, utilities, and his total expenses right here. Now, other wording in the problem shows that opening inventory was $3,000 and closing inventory was $4,000. Sam paid a minimum wage of $10 per hour to his employees during the year. And again, we have the W-3 here. The other piece of information to look at is that you can see line 1 or box 1 shows wages of $100,000, and that is being broken between two component parts: Social Security wages paid and Social Security tips. What this means is that although Sam paid $10 an hour to his workers, and obviously $20,000 total to himself for the year. The amount that he actually paid out as payroll was $50,000. But the amount that he is recording as wages on W-2 is another $50,000, and that essentially tells you that the tips that were reported to him for the year totaled $50,000. And so 50 plus 50 is the $100,000 figure up here. Moving on to the Form 1120S that we prepared for the Bear House, we can see that we've entered the gross receipts. On line 2, we've got cost of goods sold, and I'll show you where we get that figure in just a second. We then have a total income after cost of goods sold of $261,000. On line 12, we have taxes and licenses, and you will see that the total entered here is $8,175. That is not a match, if I bounce back here, to the taxes and licenses total of $12,000. It's different than that number, and the reason that it is because we have to do a factoring for the amount of credit that Sam Bear gets to claim, or the Bear House gets to claim. So the total taxes of $12,000 have been reduced by $3,825, which is actually the amount of the credit that he's going to get for the employer credit on Social Security and Medicare tax paid on tips. So we haven't actually figured the credit yet, but when we do, we're going to determine that it is $3,825, and that $3,825 can't be deducted and also claimed as a credit. That would be a duplication of that particular tax benefit. So the original expense of $12,000 is reduced by the amount of the credit, and then the difference is entered on line 12. We move on and enter the remaining expenses for this particular tax return. And then we move on to Form 1125A, which is where we figure the cost of goods sold. We have the opening inventory, we have the purchases, we have the cost of labor, we have the closing inventory, and that's where we ended up with an inventory expense of $139,000, which we then carried over and entered on line 2 on page 1 of the form. The next step is to figure Form 8846. Actually, if you're going in strict order, 8846 has to be prepared before we finish preparing the 1120, but in the order of my course, I've stuck it right here. So on this particular form, we begin on line 1 by entering the gross tips reported to the Bear House by employees who received tips, and that was $50,000. All employees were paid more than $5.15 an hour, so there's no amount on line 2. We then multiply the total of $50,000 by 7.65%. We get $3,825. None of that is attributable to a passive activity, so it's all going to be allowed on line 6. And of course, then it carries over to the K1. Because an S corporation is not a taxable entity, there's no way for the Bear House to actually claim a tax benefit for that particular credit. It's going to have to flow through to Sam Bear. And the way we do that is on line 1 of the K1, we show the net income of the S corporation. And then on line 13, we enter the amount of the credit and indicate with a code F what that particular credit is for. And then, of course, we have a little cutout here from the Schedule K of the S corporation. I haven't shown you the entire S corporation return, but on the S corporation return, there is a Schedule K, and that Schedule K is also reporting the amount of the credit, and then it flows through from the Schedule K up to the Schedule K1. And the next step is to move on to Sam Bear's personal return. He's going to have to use the K1 to prepare his personal return. He also would have received a W-2 from his S corporation because he was paid a wage or a salary of $20,000 for the year. He has some interest income we've decided to throw in there, and then we've got the S corporation profit flowing through to line 17. We figure his adjusted gross income for the year at $201,825. We decided to throw in some itemized deductions of $17,000. His personal exemption deduction is $39.50. We get taxable income of $180,875 and income tax of $43,821. Well, that puts him well within the range of the alternative minimum tax. So it's going to be necessary to complete a 6251 to determine if he owes any alternative minimum tax. The good news is that the credit for employer tax on tips is not affected by AMT. So the credit that we figure on the earlier page right here, what is this form called, 8846, the credit that he figures he's going to get it in full. He's not going to be limited by AMT. So we go down to the Form 1040 and we whack that credit amount on line 54. But we still have to do the Form 3800, don't we? Form 3800 is prepared and attached to Sam Baer's 1040 return rather than the S Corporation return because the S Corporation is a pass-through entity. You will see that unlike George Burns, Part 1 of Form 3800 is blank, and that's because the credit for employer tax on tips is not subjected to or limited by the alternative minimum tax, so Part 1 in this case is left blank. But we still have to, in Part 2, do the computations to figure out what alternative minimum tax would be. And so you'll see we have some line entries on there. You'll also see that in Part 2, limitations may come into play because of the foreign tax credit, but again, there's no foreign tax credit being claimed by Sam Baer, so it's kind of just math computations going on. Here in Part 2, we've entered on line 30 the actual amount of the allowed credit. It's allowed in full. And then we move on to Part 3 of the form, which technically is filled out first. We check box A because this is a non-passive activity. We then go down, and on line 4F, we enter the amount of the credit. We also enter the EIN of the S Corporation that the credit flowed through from, and then the credit is allowed in full. Next up, we have the Qualified Railroad Track Maintenance Credit. This credit applies with respect to qualified railroad track maintenance expenditures paid or incurred during the tax year. The credit is expired for years after 2013 unless it also is extended. 4H, credit for employee small employer health insurance premiums. So this is the big one that most tax preparers are interested in and concerned about. It's actually not a new credit. We've had it around since 2010. And I've been actually teaching about this credit since 2010. However, there are some changes that take place this year because we are now into some revised rules for figuring and claiming the credit for employer small health insurance premiums. So we're going to be on this topic for quite a while. For taxable years beginning after December 31, 2009, Section 45R of the Internal Revenue Code offers a tax credit that can be claimed by certain small business employers that provide health insurance coverage to their employees. The credit is specifically targeted to help small businesses and tax-exempt organizations that primarily employ moderate and low-income workers. The credit is available for tax years 2010 through 2013, plus for any 2 years after that. Beginning in 2014, the credit is allowed only for health insurance purchased through the Small Business Health Options program called SHOP. And the credit can be claimed for a maximum of 2 years after 2013. So for tax years 2010 through 2013, the instructions for Form 8941 went into a lot of detail about the type of health care plan that could qualify for the credit. It's really not necessary to worry about what kind of health care plan qualifies for the credit anymore because there's really only one rule for the health care plan, and that is you have to buy it through the SHOP. And of course, in order to be admitted into the SHOP, the plan has to be a qualifying plan or it wouldn't be allowed into the SHOP. So for employers who want to claim the credit for 2014, they must have purchased their health insurance for their employees through the SHOP. For 2013, the credit is available to small employers that pay at least half the premiums of single health coverage to their employees. The following employers are eligible for the credit: taxable employers, Section 501C tax-exempt employers, certain Section 501A tax-exempt employers, and certain Section 521 farmer cooperatives that are subject to tax under Section 1381. Then beginning in 2014, the maximum credit is 50% of the premiums paid by eligible small business employers and 35% of the premiums paid by eligible tax-exempt employers. For tax-exempt employers, the credit is generally 35% of the premiums paid. It is limited to the amount of certain payroll taxes paid and is claimed as a refundable credit on Form 990T for exempt organization business income tax return. A tax-exempt employer is an eligible small employer described in Section 501c3 that is exempt from taxation under Section 501a. And if you have a tax-exempt employer that is not described in Section 501c, it is probably not eligible to claim the credit. So let's take a look at what a small employer is and how to calculate the credit. For small employers, the maximum credit is available only to the smallest of employers who have 10 or fewer equivalent full-time employees and pay average annual wages of $25,000 or less. The credit is completely phased out for employers that have 25 or more equivalent full-time employees or pay average annual wages of $50,000 or more for the year. Also, you should note that the wage limit is adjusted for inflation after 2014. We've had really a kind of a fixed figure of $25,000 to $50,000 being the phase out of this particular credit since it was first introduced in 2010. For 2014, we still have that same phase out range of $25,000 to $50,000 of wages paid to a particular employee. But beginning after 2014, there's going to be an index for inflation going on. For 2015, you're going to see an increase up to $25,400 to $50,800. But the credit that has now been around for 5 years has never once been indexed for inflation during that initial 5-year period. Because of the eligibility rules are based in part on the number of full-time employee equivalent, not on the number of actual employees, employers that use part-time workers can still qualify for the credit even if they employ more than 25 people. Employers eligible for the credit: to be an eligible small employer, the employer must have fewer than 25 full-time equivalent employees, pay average employee salary that is $50,000 or less per year, pay at least 50% of a full-time employee's premium costs, and offer coverage to full-time employees through the shop marketplace. So let's talk a little bit about the shop. It could be that you are taking my class today and you are actually an employer that provides health insurance to your employees and you've been to the shop and you've used it. Just as likely you haven't done that and you're not familiar with how the shop works. And so we're going to spend a little bit of time talking about the shop so that at least you're somewhat familiar with it if your tax clients are asking you for assistance with using the shop, or they've heard that they're supposed to provide health insurance or that they might be eligible for credit, but they just don't know how to go about doing it. So the Small Business Health Options Program, or SHOP, Marketplace is a program that simplifies the process of buying health insurance for small businesses. For 2014 and 15, the SHOP helps employers with 50 or fewer full-time equivalent employees shop for, choose, and offer their employees high-quality private health plans that fit their needs and budget. Beginning no later than January 1, 2016, the shop will be available to employers with 10 or fewer full-time equivalent employees. So let's take a look. I've basically done a cut and paste to you here of the most current landing page of healthcare.gov website. So if you go to healthcare.gov and then click on the Small Business tab at the top, this is the page that you're going to see. And you can see that it says select your state. You would select the state that the employees are in and then follow through with the other prompts. But there's also some quick links to see plans and pricing, to calculate what your credit for providing health insurance might be. Actually, there's the tax credit tool here, and then there is a calculator to determine how many full-time employees you might have. And if you would like to use an insurance agent, there's a link for that as well. There's an important note here, and that is that if you are self-employed and you have no employees, you can get coverage through the individual health insurance marketplace, but not through SHOP. Benefits of using the SHOP marketplace. If you are a qualified small employer, you can receive the following benefits from the SHOP marketplace. You control the coverage you offer and how much you pay towards employee premiums. You may qualify for the Small Business Healthcare Tax Credit, which is worth up to 50% of the premium costs. You can still deduct from your taxes the rest of the premiums that you paid that are not eligible for the credit. So who can use the SHOP? Well, to participate in the SHOP marketplace, you must have a principal business address within the state where you are buying coverage, or you can offer coverage to each eligible employee through the SHOP marketplace account, serving that employee's primary work site. Also, you have to have at least one common law employee on payroll, not including the business owner or sole proprietor or their spouses if they are on payroll. you have to employ 50 or fewer equivalent full-time employees, including part-time employees. For example, 2 half-time employees generally equals 1 full-time equivalent employee. Beginning no later than January 1, 2016, the shop is going to be available for employers who have 100 or fewer equivalent full-time employees. To calculate the full-time equivalent employees when you apply for SHOP, you should use your most recent tax year. You exclude seasonal employees, those that worked fewer than 120 days in a year, from all of the calculations that you make. You then count the number of people who worked an average of 30 or more hours in a week, and add to this amount the number of hours worked per week by non-full-time employees, and then divide that total by 30. So let's do a little quick example here. Mike owns a business with 20 employees. He has 15 employees who worked an average of 40 hours a week. That would be 15 full-time employees. He also has 2 employees who worked an average of 15 hours a week, 1 employee who worked an average of 25 hours a week, and 2 employees working an average of 27 hours per week. So you can see he has 5 part-time employees. He's going to calculate his full-time equivalent employee number as follows. He begins with the actual number of full-time employees, which is 15. He then adds up all of the non-full-time employee hours. He's got 15 plus 15 plus 25 plus 27 plus 27. When he does that, he then divides the total by 30, and he gets 3.6. He then rounds down to the nearest whole number and arrives at a total of 3 equivalent full-time employees. So how many equivalent full-time employees does he have? Well, he has 15 full-time plus 3 equivalent full-time. That leaves him with 18 FTEs for the year. He is considered to be a small employer. He is not required to offer any health insurance coverage to his employees at all. But if he chooses to, he should buy his insurance through the shop. And if he purchases his health insurance through the shop for his workers, then he could be eligible to claim the credit for health insurance premiums paid by small employers. So what else happens in the shop? Well, you can compare plans and apply. You can browse the health and dental plan information using the shop premium estimation tool. You will be able to see available plans and sample prices based on several scenarios. And I've actually gone in there and played around with the shop. Just picked a particular state, pretended I have a certain number of employees, and once you do that, it will show you some of the health insurance coverage options that a particular employer might be able to choose from. There is a shop marketplace in each state. You must have an office or employee work site within the shop's service area to use that particular shop. Choose your state, and healthcare.gov will guide you to the right shop for you. There's also a credit estimator on the site that I pointed out to you. The shop provides a credit estimator, which small business owners can use to figure the amount of small employer health insurance premium credit that they can qualify for. Yesterday, I just randomly decided to look for health insurance on the shop marketplace. I picked coverage for 5 employees with a particular plan option. It came up with a cost of health insurance coverage of roughly $2,400 per month for those 5 employees. I picked a really kind of expensive plan. And then essentially what that would mean is that the employer, depending on what the average wage of the employees is, could be eligible to get half of the cost of those premiums back as a credit on their tax return. But unfortunately only for 2 years, and also limited if the average wage paid to employees exceeds $25,000 for the year. So how do you determine the employees to take into account? Well, I gave you an illustration just a minute ago, roughly loosely, of how to determine how many full-time equivalent employees you have, but there's some more instructions on that here. Password number 1 is nuthatch, N-U-T-H-A-T-C-H. So we're going to take a look now at all of the rules for determining what your full-time employee equivalent count is, how you determine what the average wage paid is, how do you finally go and figure the credit amount, how do you fill out the form for figuring that credit amount, and then how does it flow through to your individual returns. So we're going to be taking a look at that, or your business return if you're filing, say, a C corporation. So firstly, determining the employees that are taken into account. The credit is determined by accounting for the number of full-time equivalent employees and average wages paid to FTEs. Unless specifically excluded, All employees of the employer during the year for which the credit is being claimed are taken into account when computing an employer's FTEs and annual wages paid under Section 45R. Of course, that said, we're about to learn that not all employees are taken into account because there's some pretty specific groups that are specifically excluded. For example, FTEs include former employees who terminated employment during the year for which the credit is being claimed, employees covered under a collective bargaining agreement, and even employees who do not enroll in their employer's health insurance plan, whether or not they are covered under another health insurance plan, and also leased employees. But note that any employer may not claim a credit for health insurance premiums paid for by the leasing organization from which the employer is leasing an employee. So if the strategy of a particular employer is to not hire workers and lease them instead, they're still going to have to count those leased employees as employees for purposes of determining whether they exceed the minimum number of employees. So who is excluded? Well, Section 45R requires certain related and seasonal employees not be taken into consideration when calculating the amount of the credit. Seasonal employees working 120 days or less during the tax year are disregarded in determining FTEs and average annual wages. However, premiums paid by the employer on behalf of seasonal employees may be counted in determining the amount of the employer's credit. So owner employees that are not taken into account include sole proprietors, partners in a partnership, shareholders owning more than 2% of an S corporation, and any owners of more than 5% of other businesses. Family members of these owners and partners are also not taken into account as employees. For purposes of Section 45R, a family member is defined as a spouse, a child or descendant of a child, a sibling or step-sibling, a parent or ancestor of a parent, a step-parent, a niece or nephew, an aunt or uncle, a son-in-law, daughter-in-law, father-in-law, mother-in-law, brother-in-law, or sister-in-law, or any other member of the household of an owner or partner who qualifies as a dependent. So if you've got a person that you've been supporting and you've been claiming or are eligible to claim them as a dependent, even if they're not related to you, you still cannot claim a credit for health insurance premiums that you buy for them through your business. Calculating employee hours of service. 3 methods may be used for calculating employees' hours of service for the taxable year. These include counting the actual hours worked, or using a day's worked equivalency, or using a week's worked equivalency. Employers may apply different methods for different classifications of employees if the classifications are reasonable and consistently applied. This means, for example, that an employer can use the actual hours worked for all hourly employees and the week's worked equivalent method for all salaried employees. In addition, employers may change the method of calculating employee hours. So in determining the number of an employer's full-time employees, the FTE is determined by dividing the total hours of service, but never more than 2,080 hours for any particular employee, by 2,080 hours. The result, if not a whole number, is then rounded to the next lowest whole number. However, if after dividing the total hours of service by 2,080, the resulting number is less than 1, the employer will round up to 1 full-time employee equivalent. So how do you calculate the employer's average annual wages? Well, that's a slightly different formula. All wages as defined for purposes of the Federal Insurance Contributions Act, or FICA, are taken into account in computing the employer's average annual wages. However, the limit on wages subject to FICA does not apply for purposes of calculating the credit. So what this is saying is if you have one employee that you paid $200,000 for and all of the other employees were $25,000, you're not going to limit that high employee to the Social Security limit for the year, which is only $117,000. You're going to have to take into account their full $200,000 salary to average out all of the others for the year. And if that pushes you over the threshold of $50,000, then you're out and you don't get a credit. If an employee works more than 2,080 hours in a year, all wages paid to the employee, including wages for hours in excess of 2,080 hours, are still taken into account in computing the employer's average annual wages. Use the following formula to determine the average annual wages paid by an employer for a taxable year. Use the following formula to determine the average annual wages paid by an employer for the year. You take the total wages paid by the employer during the year to that employer's eligible full-time employees. You then divide that total wage by the number of eligible full-time employees to get the number that you're looking for the year. And the result is then rounded down to the nearest $1,000. And clearly, if it pushes you over $50,000, there's no credit. Doing business in more than one state. If you have employees in more than one state, you can choose from two approaches. Number one, you can choose a single health plan with a multi-state or national provider network and then offer it to all of your business operation locations throughout the country. If you choose this option, all employees and all work locations will be counted when calculating your minimum participation rate. You should create your shop marketplace account in the state where your primary business site is located. You can also create a shop marketplace account in each state where your employees have a primary work site. As long as your business meets all of the criteria to participate in shop, you can create a shop account even if you have only one employee in a particular location. If you create a shop marketplace account in each state where you have a primary work site, you will need to create different offerings in each state. The employees on each employee roster will be counted separately when calculating your minimum participation rate. If you have a business location in a state that doesn't use the federal marketplace, you can still get shop coverage through that state's shop marketplace. So there are some shop rules for employers in multiple states. You can establish only one shop marketplace account per employer identification number, or EIN. If you operate multiple businesses under the same EIN, you can establish only one shop account in a state. If you own multiple businesses with different EINs, each business is treated separately for shop coverage, and this is true whether your businesses are all in one state or in multiple states. For each business with its own EIN, you'll need to meet the shop criteria independently. You'll have to create a separate shop account, fill out a separate shop application, create a separate coverage offering, and manage the shop plans separately. When you complete a shop application for a business, you will see the plans available for that business. Create an offering that works best for that business and its employees. The offerings can be very different for each business if you want them to be. Because each business is known separately to the shop marketplace, you'll have to submit separate premium payments to shop for each business. And there is a link here for more information on that particular topic. So how do you claim the small employer health insurance credit? You've gone through all of the shop work. You've signed up for shop. You've been giving health insurance coverage to your employees, paying for that health insurance coverage. Now it's time to reap some tax benefits on your tax return. You're going to figure the credit for the small employer health insurance premiums paid using Form 8941. Small businesses and nonprofits can claim the credit as follows. An eligible small business will first use Form 8941 to figure the credit and then include the amount of the credit as a part of the general business credit on Form 3800 line 4H. For self-employed business filers, enter the amount that you entered on Form 3800 on your Form 1040, line 54, and then check box A. Attach both forms to your 1040. For tax-exempt organizations, you'll first complete Form 8941 to figure the refundable credit, and then claim the credit on line 44F of Form 990T. Though primarily filed by these organizations liable for tax on unrelated business income, Form 990T will also be used by any eligible tax-exempt organization to claim the credit, regardless of whether they are subjected to this tax. Premium deduction reduced. Your deduction for the cost of providing health insurance coverage to your employees is reduced by the amount of any credit for small employer health insurance premiums allowed with respect to that coverage. So essentially, you are allowed to claim a deduction on your tax return for the cost of health insurance premiums you pay to your eligible employees, but you cannot also claim a deduction for health insurance premiums when you've already claimed the credits. You're going to have to reduce your deduction by the amount of credit that you calculate and claim. So here is the comprehensive illustration I've been promising. I first created this illustration way back for the 2010 tax year when I first read the instructions for Form 8941, and I practically had a tantrum because there were so many pages and so many worksheets. Ultimately, the only way to understand any of it was to actually create an illustration and work my way through it. And that was when I created this illustration for Haflinger Inc., which is an S corporation. Operating a consulting firm in Omaha, Nebraska. During the year, Haflinger paid 75% of employee health insurance premiums for the following individuals under its employer plan. And you can see I've listed here 6 employees in kind of a green color and then 4 employees in a pink color. And the reason I've highlighted these employees in different colors is it basically tells you who is a qualifying employee for purposes of the FTE calculation and who is not. Jason, Martha, and Samuel are not considered in the calculation of the number of full-time employees because you have the owner, a spouse of the owner, and a brother of the owner. And then we move down to this employee, John, who is not related to the business or the business owners in any way, but he worked fewer than 120 days during the year. And so these 4 employees are thrown out for purposes of determining the number of full-time equivalent employees, and also figuring the average wages paid to employees. So they're thrown out for both sides of the computation. So to determine the amount of the credit for small employer health insurance premiums, Haflinger really needs to keep a record and present a record to the tax practitioner that includes all of the information you see here. It's pretty difficult to even begin to fill out Form 8941 if you don't have the information. So you really need to know who the employees are, what the relationship to the owner is, whether they will meet the requirement of working over 120 days. You need to know that answer, the total number of hours that each employee worked, the wages paid to the employees, the plan type, what portion of the premiums were paid by the employer, and the total cost of the premiums is a helpful number, although it's not actually entered on the form. Form 8941, line 1, we're going to enter a 6 on that particular line of Form 8941. And when we're determining the number to enter on that line, we throw out anyone who is not considered to be an FTE, and we're left with 6 people who are considered to have been employees for purposes of our calculations. The next step is to move over to worksheet number 1. And part of the effort to calculate this particular credit carries the preparer through 8 separate worksheets. So not only does the small business owner have to compile information in a manner that is usable to the tax practitioner is then going to use that information to go through and fill out 8 separate worksheets to fill out eventually the form. This is worksheet number 1. It's included in the instructions for Form 8941. And what worksheet number 1 asks you to do is to list all employees who are taken into account. In other words, all employees who were not excluded. There were 6 employees that were not excluded. And how many hours of service did those employees put in? We total those up, and we have 10,520 hours. And then what was the wages that was paid to those 6 employees? That totaled $181,800. So the employees not included on worksheet 1 are Jason, the owner, Martha, the spouse, Samuel, the sibling, and John, the seasonal employee who worked 120 or fewer days during the year. We then move on to line 2 of Form 8941, and on line 2 of the form we're going to enter a 5. How do we figure out that number 5? Well, that's the number of individuals that were employed full-time, and it can be less than the number of individuals that were actually employed. So we're going to use worksheet 2 to figure out that the number we're going to enter on line 2 of the form is a 5. So we begin with the total number of hours worked by all non-excluded employees, and we enter that number of 10,520. We then divide that by the number of hours a full-time employee works in a year, and that's 2,080 hours in a year. We divide that in, and we ended up with 5.058, and we round that down to 5. So we have 5 equivalent full-time employees out of 6 employees that are not excluded, out of 10 employees of which 4 were excluded. So bottom line, on line 2 of Form 8941, we're going to enter a 5. Next, it's time to move on to line 3 of Form 8941, and our purpose here is to determine what the average wage paid to employees during the year was. And of course, we're now looking at the total wages paid to the 6 non-excluded employees, but we're dividing that total wage paid by the number of FTEs, which in this case is 5. So up here on this worksheet, we can see that there's 6 people listed who earned $181,800 for the year, but not all of them were full-time. So we're going to have to come up with the FTE equivalent, which is 5 employees, and then we're going to divide 5 into that $181,800, and when we do that, we get $36,000. We actually get $36,360, but we're going to round that down to the nearest $1,000, and that's where we get $36,000. Time to move on to line 4. We've determined that the average wage paid to the FTEs is $36,000 per year. That's more than $25,000, so we know we're going to be in a phase out, as opposed to this number right here, which is only 5. So we know that there will be no phase out affecting Haflinger Inc. because the number of full-time employees exceeds 10 workers for the year. But we are going to be subjecting Haflinger to a phase out because the average wage paid to those workers is over $25,000. So the next phase is, of course, to figure out what amount we're actually going to get to claim for the credit. On line 4, we enter $15,570, and we figure that by taking the employer share of the premiums that were paid. So there was the total cost of premiums paid, and then there's the amount of premium that was actually paid by the employer. We need to know that the employer paid at least half of the employee portion, the employee-only coverage. And in this case, Haflinger was far more generous than that. Haflinger paid 75% of both individual and family coverage, and Haflinger's share of the premiums paid was $15,570. And of course, that number is entered on line 4 of 8941. Then we move on to line 5 of 8941. Of course, we need to do another worksheet. The number that we're going to enter on line 5 is $21,365, and to figure that, we're going to enter the total amount of average premiums for the state each Haflinger Inc. employee worked in. Well, this was a number that I wasn't actually able to update for you. You can see that the illustration that I've been working on for you is using 2014 tax law. I've filled out Form 8941 for 2014, but IRS, as I'm teaching this class today on November 18, has yet to release the updated instructions for the form, and I've looked everywhere and I just can't find the average premiums for each state. So I've just defaulted to the average premiums for Nebraska in 2013 and put those on the form. They ultimately don't affect our calculation. The whole point is that the employer premiums taken into account for purposes of calculating the credit cannot be greater than what the employee share would be of the average premium paid for any particular state. The instructions for 8941 show the average premium paid on a state-by-state basis, and for Nebraska in 2013, that state average was $5,463. Don't know what the average for Nebraska is for 2014 yet, but it won't be a heck of a lot different. Ultimately, you're going to multiply that out by the number of workers that are receiving coverage, health insurance coverage. In this case, that's 4, and one of those is receiving family coverage. So this is the amount of employer premiums paid. This is the state average cost of those same premiums, and the credit cannot be based on a number higher than the state average. And of course, for Haflinger, the number is less than the state average. So whether the state average goes up or stays the same, it doesn't really affect our computation. It merely affects the number we enter on line 5. So we use worksheet number 4 to add up the premiums paid for each employee. Haflinger Inc. paid 75% of the cost of employee premiums. Therefore, the amount in column B is 75% of the total cost of premiums paid. You then add up the average amount of premiums that are allowed for each employee based on the type of coverage and employer percentage paid for the state that the employee worked in. That's this number. You then add up the number of hours worked for the year for each employee enrolled in the employer-provided health care plan, and that's this number in column D. Next step, line 6. Enter $15,570. The credit is based on the lesser of the actual employer premiums paid or the limit for the state that the employee worked in. In this case, it's the amount in column B. Since the amount paid for premiums by Haflinger Inc. is less than the average for health insurance costs in the state of Nebraska, the average amount is not going to limit Haflinger at all. Moving on to line 7 of Form 8941, we're going to enter $77.85. How did we figure that? Well, the maximum credit is 50% of the premiums paid by the qualifying employer. Haflinger paid $15,570 in premium payments. Half of that amount is $77.85. $77.85 is therefore the maximum potential credit that Haflinger Inc. may be able to claim. The credit can be reduced below this amount if Haflinger has more than 10 full-time equivalent employees or pays average wages of more than $25,000. Well, we already know that the answer is no to this bullet point. They have only 5 equivalent full-time employees, but they did pay average wages of $36,000, so there's going to be a phase-out affecting them because of the wages paid. We're now going to move on to worksheet number 8 to determine if the credit will be reduced because of the number of full-time employees is greater than 10, and worksheet 9 to determine if the credit will be reduced because the wages exceed $25,000. Firstly, I do worksheet 8. Technically, I don't have to do worksheet 8. The math in my head already tells me we're at 5, which is less than 10, but I filled out the worksheet anyway just to show you how it works. We enter the full amount of the potential credit that this particular employer could get, $77.85. We then enter the number of full-time employees that Haflinger has on line 2, which is 5, and on line 3 we subtract line 10, subtract 10 from line 2, that's what I thought. The whole point is to determine if we're going to have a number on line 2 that is over 10, because if we do, then we would have a number difference. And essentially, 5 is less than 10, so we enter a 0. But if we had a number like 15, then we would have a phase-out going on for the number of employees. But we don't have a phase-out, so we enter a 0. Next, we have Form 8941, where we are going to be dealing with a phase-out because of the wages paid. And in this case, the total amount of credit that Haflinger will be eligible is $4,360. That is down from $77.85. How did we figure that? Well, we begin by entering the maximum potential credit. Then on line 3, we enter the average wages paid. We subtract from the average wages paid $25,000, and when we do that, we get $11,000. So the phase-out range for wages is $25 to $50. That's a $25,000 phase-out range. Haflinger is $11,000 into that $25,000 phase-out range. That means that they are losing 44% of the credit. They're 44% into the phase-out range. So 44% of $77.85 is $34.25. That's the amount of credit they don't get. And the difference is $43.60. That is the amount of credit that they are actually left with. And we're going to enter $43.60 on line 9 of Form 8941. We then move on to Live 10. We leave this particular line blank. Haflinger Inc. did not receive any kind of state subsidies or tax credits for premiums reported on line 4. Some states do give employers credits for the cost of health insurance premiums, and if Haflinger had received such a state subsidy, then that state subsidy could reduce the potential credit that that employer is receiving. Haflinger received no such benefit, and so Live 10 is blank. Moving on to line 11, enter $15,570. Since Haflinger Inc. did not receive any state assistance, there is no reduction in the amount of expense they have. On line 12, enter $43.60. This is the smaller of the credit calculated, or Haflinger Inc.'s allowable expenses minus the state-provided assistance. Then on line 13, we enter a 4. 6 employees were included on Form 8941 line 1, way back up at the top. However, premiums were only paid for 4 of those employees. So they want to know the number of non-excluded employees. They want to know the number of equivalent full-time employees, and then they want to know how many employees actually had health insurance coverage. And 4 employees actually had health insurance coverage. And so that's the amount entered. Next step, here we have worksheet number 7. Use worksheet number 7 to figure the number of full-time employees enrolled in health coverage provided by Haflinger Inc. And line 15, we're going to leave that blank because Haflinger Inc. does not have income deductions or credits from ownership or interest in a partnership, S corporation, trust, or estate. Finally, on line 16, we're going to enter $43.60. Haflinger Inc. is an S corporation. The credit entered on line 16 of 8941 will carry to Schedule K of Form 1120S, and then the credit will be divided between the shareholders in Haflinger Inc. based on their pro rata share of ownership. Schedule K1s will be then issued to each shareholder, and the amount shown on line 16 of Haflinger Inc.'s Form 8941 will carry to line 13 of each shareholder's K1, and each shareholder will need to prepare and attach Form 8941 to his or her individual 1040 return, of course, along with Form 3800. And here is what the finished 8941 looks like. You can see up at the top, we enter the name that is shown on the return, the EIN of Haflinger Inc. Did you pay premiums during the tax year for employee health insurance coverage provided through a small health options program or shop? You need to answer yes. And then you want to enter your marketplace identifier. Finally, on line B, you enter the EIN that was used to report employment taxes for the individuals that are included on line 1 below. In this case, it's the same as the identifying number used on the return, but it's possible there's a difference. Then we enter all of the numbers I figured using all of those various worksheets. Line 16 is the final place where we stop because this is an S corporation, and that is where S corporations stop. All right, now, can you estimate more easily than filling out the form and filling out all those worksheets? The answer is yes. Healthcare.gov, I showed you earlier, does provide an estimator tool for figuring the credit. I went in there yesterday before I taught this class and actually used the tool, and it was spot on. Nice to see. I started by telling the shop what state I was operating out of, in this case, Nebraska. And then I entered the number of full-time employees. To do that, I obviously had to do the worksheet to figure out how many full-time employees I had, and I obviously had to do the worksheet to determine the average wages paid. But once I had those figures, I then entered the total premiums paid for that particular business, and it came out with $4,360 as the final credit. So it was nice to see it was an exact match to all of the math computations I'd done. So now we're going to move on and talk a little bit about the health insurance mandate for employers. This is not a credit, and in fact, any employer affected by the health insurance mandate would automatically not be eligible for the credit. So they're really related and not related. This is a class about credits, but I know that anyone taking the class and getting information on the small employer health insurance premium credit is automatically going to have going in the back of their mind, what about the health insurance mandate? So I felt that this would be a good place to talk about the health insurance mandate, who is affected by it, what kinds of businesses are affected by it, and so we've got a few pages on this particular topic. So the Affordable Care Act encourages, but specifically does not require, employers to provide some degree of coverage to employees and their dependents. Encouragement is provided in the following ways. Firstly, additional taxes or penalties called the employer shared responsibility payment can be assessed on an applicable large employer who does not provide coverage to its employees and their dependents. And there is also the credit for small employer health insurance premiums, which is available to certain qualified small employers who provide coverage to their employees. For 2014, no employer is required to offer health insurance coverage to its employees, but beginning in 2015, which is just a month and a half away, not even that, January 1, 2015, we're in the new year. Beginning in 2015, employers that don't offer coverage meeting certain standards may have to make a shared responsibility payment or pay an additional tax if they have 50 or more equivalent full-time employees and they have at least one of the uncovered full-time employees goes to the marketplace and gets a subsidy for purchasing individual coverage on the marketplace. So if you are an employer and you have 50 or more equivalent full-time employees, and you fail to offer adequate coverage to these employees, and one of those employees goes to the marketplace and purchases individual coverage, then the employer can be subject to a penalty. Employers with fewer than 50 employees are not subject to the employee shared responsibility parts of the law. So in other words, if you are a business that has fewer than 50 employees, you don't have to provide health insurance coverage to your employees at all under any circumstances. If you choose to offer coverage, you may be able to claim the credit for health insurance premiums that you buy for those employees, doing all the computations that I just showed you, purchasing health insurance through the shop and so forth. If you are an employer who has 50 or more equivalent full-time employees, you are required to provide health insurance to any of the employees who meet the criteria. And if you fail to do so, then you can be subjected to a penalty, but only if a non-covered employee or an employee who has refused coverage because it wasn't affordable goes to the individual marketplace and buys coverage. So let's take a look at that penalty. Beginning in 2015, applicable large employers who do not provide affordable coverage to employees and dependents of the employees may be required to pay a shared responsibility penalty. The penalty applies if The applicable large employer fails to offer affordable insurance to a full-time employee that meets minimum essential coverage requirements, and the full-time employee receives a premium assistance credit. How much is the penalty? Well, the amount of the penalty assessed to an employer who does not offer coverage will be equal to the number of its full-time employees minus 30 multiplied by $167 per month or $2,000 per year. After 2014, the amount of that penalty will be indexed for inflation. So for purposes of employee coverage, who is a dependent? Well, a dependent is the employee's child who is under the age of 26. An employee's child must be offered health insurance by the employer until the child's 26th birthday. The child does not have to be a dependent for income tax purposes. An employee's child includes his son, daughter, stepson, stepdaughter, legally adopted child, or an eligible foster child placed by an authorized agency. For spouses, for purposes of the Affordable Care Act, a dependent does not include a spouse. Although many employers choose to offer coverage for spouses of employees, they are not required to do so under the Affordable Care Act. Thus, an employer who chooses not to offer coverage to an employee's spouse will not be subjected to the shared responsibility penalty. A spouse can obtain coverage through his or her own employer or through the marketplace. Applicable large employer defined. An applicable large employer is an employer who, for the year, is determined to have at least 50 full-time or full-time equivalent employees. The following aggregation rules apply when determining if an employer is an applicable large employer. Now, the first thing I do need to point out is that we went through Form 8941 and did a bunch of computations to figure out who full-time equivalent employees were for purposes of the credit for health insurance premiums paid by small employers. The definition of full-time employee for the applicable large employer is similar, but not identical. So when you're looking at the rules for full-time equivalent employees, you really need to look specifically at why am I doing this computation? Am I doing the computation to determine whether I'm a full-time employer subjected to the penalty, or am I doing the computation to determine if I can claim the credit for small employer health insurance premiums? Although almost identical, they are not perfectly identical. There are some subtle differences. So the following aggregation rules apply when determining if an employer is an applicable large employer. Firstly, all entities controlled by a single employer are treated as a single employer, and entities that are members of a controlled group are considered to be one employer. Full-time employee defined. A full-time employee is an employee who is employed at least 30 hours per week, or an equivalent 130 hours per month. There is an exception. If the sum of full-time and full-time equivalent employees that an employer has exceeds 50 for 120 or fewer days during the year, then seasonal employees are not counted when determining the number of full-time employees that an employer has. What it's saying is that if an employer exceeds 50 employees for fewer than 120 days during the year, because some of the employees used to figure that 50 quota were seasonal, then you throw out the seasonal employees and recalculate. If you recalculate and you're less than 50, then you are not considered to be a full-time employer. So let's take a look at some of these formulas. Full-time equivalent employees defined. The law provides that the hours worked by 2 or more part-time or seasonal employees must be added together to determine the number of full-time equivalent employees that an employer has. The number of full-time employees an employer has is calculated using the following formula. You take the total number of hours of service for employees who are not full-time and divide that by 120. The following rules apply when figuring the total hours of service worked by non-full-time employees. No more than 120 hours of service can be used for any employee in a month. For hourly employees, the actual hours of service must be used. And for non-hourly employees, employers must use the actual hours worked, days worked equivalency, or weeks worked equivalency. The method used must accurately reflect the hours of service performed by an employee. So here is an example. We have an applicable large employer determination. Klinger, LLC, has 40 full-time employees, each of whom averages 37 hours of service per week, and 35 part-time employees, each of whom averages 100 hours of service per month. figure the number of FTE employees that Klinger has as follows. Determine the number of part-time hours worked. Well, that would be 35 employees times 100 hours, or 3,500 hours. Divide the number of part-time hours by 120. 120 into 3,500 is 29 full-time equivalent employees. Add the full-time equivalent employees to the actual full-time employees. 29 equivalent full-time employees plus 40 full-time employees equals 69. To determine that Klinger LLC is an applicable large employer with 69 full-time and FTE employees. Klinger LLC is an applicable large employer and is therefore required to offer health insurance coverage to its full-time employees beginning in 2015. Now, the number of full-time equivalent employees may not equal the number of employees that requires coverage. So the first step is to determine, am I an applicable large employer? I go through this formula with my full-time equivalent employees, add it to my full-time employees, and see what I get. Do I go over 50? If I do, I am considered to be an applicable large employer. But even though I'm considered to be an applicable large employer, it doesn't mean that I have to offer coverage to the part-time employees. I only have to provide coverage to the full-time employees. So different rules apply when determining the number of employees that a business has and which of those employees must be offered health insurance coverage. Part-time worker hours were used to determine if Klinger LLC is an applicable large employer. However, Klinger LLC is not required to offer health insurance coverage to workers who worked fewer than 30 hours per week. So as an applicable large employer, Klinger LLC must provide health insurance coverage to its 40 full-time employees. No coverage mandate applies to the 35 part-time employees. So Klinger has 69 full-time and full-time equivalent employees. So it is an applicable large employer. But Klinger LLC only has to provide health insurance to the 40 full-time employees. The 35 part-time employees are not required to be covered with health insurance paid for by Klinger. So which employees must be offered health insurance coverage? Well, an applicable large employer must offer health insurance coverage to an employee who is reasonably expected to be a full-time employee and is not a seasonal or variable employee, no later than the end of the employee's initial full 3 calendar months of employment. If the employer fails to offer coverage by the end of the 3rd full calendar month, then the shared responsibility payment penalty may be assessed on the employer for all months that the employer worked from the date of hire. So let's look next at classification of employees. Because the shared responsibility penalty applies only to full-time employees who are not variable or seasonal, employers will need to determine or develop systems to classify and track the types of employees they hire. Firstly, employees classified as full-time must be offered coverage within the first 3 months of employment. For variable or seasonal employees, we've got different rules. Firstly, for variable, part-time, and seasonal employees, they're exempt from the shared responsibility penalty. However, employers must be careful to apply certain procedures to ascertain if an employee is truly variable or seasonal in nature. If an employee is determined to be full-time and not seasonal or variable under the measurement procedures described by the IRS regulations, then the shared responsibility penalty can be applied. Employees who previously were variable or seasonal may transition to full-time, and employers must utilize a series of written procedures that meet IRS guidelines to carefully track their employees and to ensure coverage is offered to an employee when it is required. So the employer has to have a system of procedures in place that tracks a particular employee and consistently and accurately determines whether that employee is seasonal or variable in nature. And when it is determined that the employee is no longer seasonal, then the employer has to offer health insurance coverage to that employee when the employee works more than 30 hours per week. So there is a place that you can go to get some information on different procedures or systems that an employer could use, and that is the Healthcare Reform Quick Finder Handbook. It has a bunch of comprehensive examples and further information for determining an employee's status as full-time, seasonal, transitional. I've not put it in the course because it's just too much information, too specific, but it provides some mechanisms or illustrations that you could use when working with a tax client to apply formulas to determine if that tax client has seasonal or variable employees who have moved into a non-seasonal nature, and once they've moved into a non-seasonal status, if they are full-time, have they been given coverage? Now I have an example here of a seasonal worker who has become a full-time employee. Klinger LLC employs 40 full-time and 35 part-time employees. Jake has worked as a part-time employee for the past 2 years. In 2015, he transitions to full-time status. Klinger LLC must employ a written system that tracks the number of hours Jake works each week. The system must apply an initial measurement period, a stability period, and administration period, which identify when Jake is determined to be a full-time employee. The time frame for making this determination can be as much as 12 months, but must fall under a written system that meets IRS regulations, and Klinger LLC must apply the system uniformly to all of its employees. So the next step is that an employer must offer affordable coverage to its employees, must be able to show or demonstrate that it actually provided affordable coverage to its employees. And I think that this is actually a good time to take the final break of the day. Yeah, final break of the day. And I'm thinking that while we're on our break, I'd like you to work through a classwork problem. You're not going to be able to finish it during the break, but let's go through it so you can kind of mull over it a little. The classwork problem is shown, getting back here, on page 77 of the manual. And on page 77, we have some instructions relating to preparation of a tax return for a character named Chick Yoke, who is a single filer. Chick runs a sole proprietorship called the Egg Shack, which is a small breakfast restaurant in Madras, Oregon. The Egg Shack had the following income and expenses for the year, and opening inventory was $1,200 and closing inventory was $1,000. The Egg Shack had $260,000 of income. For cost of goods sold, there were purchases of $40,000. There was cost of labor that Chick recorded in her books of $86,432, but $20,000 of that payment for cost of labor is for Chick herself. We then have expenses for advertising, rents, taxes, and licenses. Payroll taxes were $7,377 and other taxes total $2,000. We have accounting fees, utilities, interest on a business loan, and finally health insurance premiums. Totaled $13,260 for the year, and $4,080 of those premiums were paid for Chick. Now, during the year, Chick paid 75% of insurance premiums for employee health insurance coverage under SHOP. She also paid her own health insurance coverage under that same plan. Chick qualifies as an eligible small business employer, and we've gone through the trouble of doing a table for you to see who all of her employees were and the amount of health insurance premiums that she paid for those employees. We've also included her W-3 showing the average annual wages that were paid for the year, the wages that were paid for the year. And Chick made timely estimated tax payments for herself during the year totaling $30,000. So here is her W-3. And there's a couple of hints I've thrown in here into this problem. Social Security tips are income to her employees, but they are not an expense to Chick. Chick is responsible for paying the employer's share of Social Security and Medicare tax on employee wages and tips. This is why the total Social Security and Medicare wages taxes are assessed on $96,000 of wages, but only $66,000 is deductible as a wage expense for Chick. Chick paid herself $20,000 and included the expense on her books, but obviously $20,000 that a sole proprietor pays to themselves is not an expense of the business, and you need to factor that in. Password number 2 is Finch. F-I-N-C-H. Finch. Whenever I create a course, I am thinking about the actual act of learning how to do a tax return based on the knowledge that I'm relaying through the course. And of course, active tax preparation means that you're filling out tax forms, and to fill out tax forms, you have to have some knowledge of how to do so. So I just feel it's an important part of the learning process to cover the mechanics of filling out the tax forms and then to have my students work along through those. Now, if you're attending a webcast, the entire nature of a webcast is that you sit passively and get hours for just listening to me yabber on. But if you're a self-pay student, there's actually a requirement through NASBA and IRS and various other agencies that accredit schools like ours that the students actually show that they've gone through the material and have learned something. And so for people who are self-paced, these assignments really do become mandatory. But for the webcast students, I still like to go through and spend a little bit of time working on them and give you an opportunity during a break to think about it a little. So in this particular classwork assignment, we have a sole proprietor named Chick Yoke who's running a restaurant called the Egg Shack. She has some employees for the year. Because she has employees and she paid tax on tips that they've received, she's going to be eligible for the employer credit for payroll taxes on tips. And because she provided her workers with health insurance, she's also going to be eligible for that small employer health insurance premium credit. So I provided you with the information necessary for computing these particular credits for Chick. And at this point, I'm going to open up the answer key for you and show you the computations that we did with respect to Chick. It's a little bit of a challenge to kind of fit all of this on the screen so you can see everything going at one time. One of the things that we did do in preparing this particular assignment and all of the illustrations that you've seen in today's course is we've actually gone to the IRS website, found the fillable forms, and done them all by hand because our software it just isn't out for the 2014 tax year yet. And interesting to work through all of these without using software, just to remind yourself of the work involved. But also it reveals it's not actually that hard to do forms by hand. Although the software is nice, it actually isn't that big an ordeal to do them by hand. And in preparing for today's class, you can see we did a number of illustrations, all of them by hand. And firstly, we have the character named Chick Yoke. We've got her 1040 return. And on the front of the 1040 return, on line 12, we've entered her net profit from her sole proprietorship. Clearly, to get to this point, we had to do the Schedule C, so I'm going to show you that in just a moment. We're also showing a couple of adjustment items on Chick's return. One of them is a 50% deduction for her self-employment tax, and the other is the adjustment to income for the health insurance premiums she paid on herself. So if you remember, we go back over here to the problem itself, and I'm showing you that she paid health insurance premiums during the year totaling $13,260, and that $4,080 of premium was for herself. Any amount of health insurance premium she paid for herself is not going to be deductible as a business expense, nor is it going to be eligible for the health insurance premiums paid for her workers, the credit on that. Ultimately, the only benefit she is allowed is to claim the self-employed health insurance deduction, and so we have given her that and entered on line 29 as an adjustment. So her total adjustments for the year are $12,727, and that gives her adjusted gross income of $109,000 for the year. We decided to just give her a standard deduction. The 2014 standard deduction is $6,200. The 2014 personal exemption amount is $3,950, and that gives her taxable income of $99,519. If you go to the tax tables, that gives you $21,041 of tax. From this point, we're going to move on to look at the Schedule C that we prepared for her and also the general business credit and accompanying forms that we prepared for her. When we finish computing her general business credit, we're going to check box A on line 54 and enter the amount of the credit. It actually comes to $6,885, and of course I'm going to show you how we calculated that. The self-employment tax that we figure for her based on her self-employment earnings is $17,294. And in the wording of the problem, we told you that she paid $30,000 of estimated tax for the year. So let's move on to the Schedule C for Chick. And the first thing we come to on Schedule C is that we're going to have to analyze some of the information provided for you in the P&L right here. And on this P&L, I've just taken it and smacked it onto the answer key, so it's kind of an illustration to work it next to. And I've highlighted some important features. The first thing is cost of goods sold. Of course, cost of goods sold is reported on page 2 of Schedule C. And we have to be careful that in that cost of goods sold, we don't include any amount of the cost of labor that is for Chick. But also, we're not going to include any kind of cost of goods sold item for wages that were not actually paid out by Chick. So when we looked at the actual wages that Chick paid to her workers, we've got $66,000 after we subtract out the wages or the draw that Chick took for herself. So we have $66,432 up here as opposed to $96,000 over here. And that $30,000 difference is tips that the employees received, but they were paid by the customers of Chick. They weren't paid out by Chick herself, so they're not a deduction for Chick. So we're going to go back and figure that the cost of labor she's going to enter on her Schedule C is going to be $66,432. She had purchases of $40,000. And if we move over to page 2 of the form, you can see here that her opening inventory was 12, purchases were 40, her cost of labor is 66, her closing inventory is 100, and her cost of goods sold is coming out at 106,632. So that number pulls over and is entered on line 4. We subtract that from her gross sales, and we end up with gross income before expenses of $153,368. We then enter the expenses that we provided for you on the P&L up here. We have advertising, rents, taxes and licenses, health insurance premiums, and a number of other expenses. Specifically, under the taxes and licenses, I've highlighted that in green and then pulled that number down to line 23. The number I'm entering on line 23 is less the number appearing on the P&L, and that's because we're going to have to reduce the tax and license deduction by the amount of credit that Chick is paying for the employer credit for tax on tips. So that means we obviously have to figure out what that credit is. Once we have figured out what that credit is, we subtract the credit amount from the expense and enter the total, $7,082. Well, incidentally, when I get to the point where I have figured the credit is $2,295, and $2,295 is then subtracted from the total of the payroll taxes, and then the net is $5,082. We add that to the other taxes that she paid, and we end up with $7,082 as the deduction entered on line 23. Moving back up to the P&L, we also have this health insurance premiums deduction. It totaled $13,260, but remember we have to subtract out $4,080 as the insurance premiums paid for Chick. Then we're going to take the difference and use that difference to figure the credit for employer health insurance premiums. So let's go through and fill out the 2 forms that we need to fill out for Chick. Well, actually, a bunch more forms. Firstly, we have the 3,800, but let's bounce back past that onto the credit for employers' Social Security and Medicare tax on tips. We start out with the gross tips that were reported by the employees. All of the employees received at least the minimum wage of $5.15 an hour. So there's no entry on line 2. We then take $30,000, multiply that by 7.65%. We get $22.95. And that is going to then carry to form 3,800 in Part 3 and is entered on line 4F. We then move over to the 8941. And on Form 8941 for Chick, we have quite a few computations that need to be done. So I'm just going to blow this screen up a bit, make it bigger, because there's so much going on here. And in the earlier illustration with Haflinger Inc., I kind of went through and did a layout of each particular worksheet. I then explained how the worksheet was figured. Here for Chick, I've tried to squeeze everything onto the same page as the 8941 itself. It was a tight squeeze, but hopefully you can read it here with me. We begin with worksheet number 1, which shows the particular employees that Chick had. And these employees were all listed in the wording of the problem. I gave you a table for that. You can see that she's got 3 employees to whom she paid wages, and each of these employees was a full-time employee. Total number of hours worked by these full-time employees is 6,240, and the total wages paid to these 3 employees is 62,400. So she's going to go over to Form 8900. She's going to enter her identifying number. She's going to enter the marketplace identifier. And then she is going to go on and enter the number of individuals she employed during the year and the number of full-time employees that she had during the year. And it turns out those are the same number. It then goes through and says on worksheet 2, enter the total employee hours of service, divide that by 2,080, and that's where you get 3. So she has 3 employees and she has 3 equivalent full-time employees. She then goes over to worksheet number 3. She enters the total employee wages that she paid for the year, divides that by 3, rounds down to the nearest $1,000, and when she does that, she gets $20,000. So she's looking pretty good here because the average wage that she's paying to her workers is less than $25,000. She's clearly got less than 10 equivalent full-time employees. So her credit's not actually going to be limited. She's going to get 50% of her premiums back at her. So the next step is to actually figure out how much she paid in premiums. It's $9,180. She enters that on line 4. She then looks up the state average for premiums paid in her state, which is a higher number. So she's not going to be limited by the state average for her state. And then the next step is to multiply by the applicable percentage, which in her case is 50%. So that gives us $4,590 as her eligible credit. She's got no other limitations going on with that credit with respect to other calculations going on the form. So essentially she's done. $4,590 is her credit. She's going to carry that over to Form 3800 and enter it on line 4H. So let's go back up to Form 3800. And we begin Form 3800 by completing Part 3. She is going to again check box A because this is a non-passive activity. And on the form, she goes down to line 4F and enters the amount of her employer credit for tax on tips. She goes to line 4H and enters her employer credit for health insurance premiums paid. And she totals those two numbers up and she gets $68.85. Next, she needs to go up and prepare page 1 of Form 3800. Again, as in our illustration with the Bear House, Part 1 is blank because there was no credit being claimed that's subjected to the alternative minimum tax. The Bear House had no alternative minimum tax figuring on Form 3800. And the same is true of Chick. Both the credits she's claiming are claimed on line 4, and line 4 does not carry to Part 1. But she still does need to complete Part 2 of Form 3800, and that includes computations to determine what her alternative minimum tax is. When she's done with all of this, her alternative minimum tax, $14,786, is less than the tax figured under the regular tax. She's not going to be paying AMT. She's also not going to be subject to a limit on the amount of credit she can claim. The credit of $62.55 is allowed in full. You just continue filling out the form, and when she's done, then it's time to go back up to the 1040. And that credit is entered on line 54. She just goes through and finishes figuring it out, and she ends up owing $1,450. So that is the conclusion or the summary of how to prepare the classwork assignment for Chick. Let's go back to the manual and pick up where we left off before the break. All right, so we're going to take a look at determining if coverage is affordable. So under the Affordable Care Act, there is this employer mandate. And employers are required to provide their employees with affordable health insurance. The employer is required to pay a minimum portion of that health insurance for its employees to such an extent that the employee's share of the cost of the insurance is not more than 9.5% of the employee's household income. So how is the employer supposed to know what the employee's household income is to make a determination whether or not the employer is paying enough of the coverage for that employee that the employer won't have to pay a penalty for not providing affordable coverage to the employee? It's kind of a long how do I figure that out? And of course, there's a bunch of rules about how to figure that out. So determining if coverage is affordable. Coverage is considered to be affordable to an employee if the lowest cost of self-only coverage does not exceed 9.5% of the employee's household income for the year. An applicable large employer is not required to offer family coverage that does not exceed 9.5% of the employee's household income. Thus, if an employee could accept self-only coverage but costs 9% of her household income, and because of the cost of family coverage exceeds 9.5% of her income, then chooses to use the marketplace to obtain coverage for her dependents, well, the dependents could receive a marketplace premium assistance credit, and the employer would not be subject to a shared responsibility penalty. So the employer is required to ensure that the employee's cost of self-only coverage does not exceed 9.5% of that employee's household income. The employer is not required to provide family coverage that does not exceed 9.5% of the employee's household income. So the employer can offer coverage to the employee. If the employee determines that the coverage is not affordable for the whole family, but is affordable for him or herself, then they are required to accept the health insurance coverage from that employer. If they don't, then they wouldn't be eligible to purchase coverage for themselves on the marketplace, and they would be subject to a penalty for failing to have coverage on themselves. So individuals have to pay a penalty if they don't have coverage, and large employers are required to pay a penalty if they don't offer affordable coverage. Somewhere on the fringe of all of this, we have the dependents. If it is determined that an employer is offering affordable single coverage but unaffordable family coverage, the employee can accept individual coverage for themselves through their employer and then go to the marketplace and purchase insurance for their children. And very often it could be the case that those children could qualify for free health insurance through the marketplace. I don't really cover that in today's class, but in the 2014 tax law update, I actually go into showing how I actually have created an illustration where we've got a taxpayer who is purchasing health insurance for themselves through the marketplace, but they don't need to purchase it for their children because their income is low enough that the children actually get free health insurance through the Medicaid program. All right, so now how does an employer know what an employee's household income is so that they can determine that the health insurance they're offering that employee does not exceed 9.5% of the employee's income? They don't know what the other income of the employee might be. Does the employee have another job? Are they married? Do they have other income coming into the household? Are they expected to make all these inquiries to figure that out? The answer is no. Instead, there is an affordability safe harbor rule. An employer may not know what the household income of an employee is and therefore may not be able to determine if the cost of insurance that it offers to an employee exceeds 9.5% of that employee's household income. Therefore, the IRS allows 3 safe harbor rules that can be applied to determine if the employer-sponsored insurance is affordable. Firstly, there is the Form W-2 Safe Harbor Rule. Then there is the Rate of Pay Safe Harbor Rule. And finally, there is the Federal Poverty Line Safe Harbor. An employer that meets one of the Safe Harbor rules with respect to an employee will not be subject to a shared responsibility penalty provided the employer applies that safe harbor method on a uniform and consistent basis for all employees. Firstly, let's take a look at the W-2 Safe Harbor Rule. The W-2 Safe Harbor method is met if the employee's share of the cost of self-only premiums does not exceed 9.5% of the employee's Form W-2 wages. The employee's contribution amount must be a consistent amount or percentage of income throughout the plan period. The employer cannot make discretionary adjustments to the employee's share of the cost of premiums for a particular pay period. So you might have an employee who is paid on an hourly basis, and some months they earn more money than other months just because of their hourly rate. The employer is going to have a uniform and consistent method of figuring that 9.5% limit without regard to any variability in the amount of pay that an employee is receiving in any particular month, if that rate varies. Then there is the Rate of Pay Safe Harbor. Under the Rate of Pay Safe Harbor method, the employer uses a formula to determine if the employee's share of the cost of coverage exceeds 9.5% of the computed assumed monthly wage. And then there is the Federal Poverty Line Safe Harbor. Under the Federal Poverty Method, an employer-sponsored coverage is considered affordable if it does not exceed 9.5% of the federal poverty line for a single individual. And there's a table for the federal poverty line in a variety of different places. I didn't put it in the manual here. Determining if coverage is adequate. So the coverage has to be affordable, and it must also be adequate. So what does adequate mean? Well, both private and employer plans must provide a minimum amount of coverage. A plan is considered to provide adequate coverage if the plan's actuarial value is at least 60%. So what is actuarial value, you're asking? Well, that was certainly the question I asked. What is actuarial value? Well, actuarial value is the total allowed costs that a plan is expected to cover. The Affordable Care Act identifies a range of services that must be included in the benefits package that all individual and small business plans must use and requires preventative services be covered with no patient cost sharing. These requirements apply to all tiers of health insurance coverage, meaning that differences in the level of coverage will reflect variation in cost sharing, but not differences in the underlying benefits. Now, if you really want to get into actuarial values, because this is just a real big issue to you and you want to study it and get to know it cold, I can provide you with a reference provided by Kaiser Family Foundation. I have a link to it here. It's a document entitled, What Do the Actuary Values in the Affordable Care Act Mean? You can go there and read about it. But while we've been talking about the different types of plans and the cost of those plans, I thought that it might be a good time to actually take you to the internet and show you the Affordable Care Act website. If you haven't already poked around in it, I'm going to do it with you now. So here we are on the Affordable Care Act site, healthcare.gov. And you can see that there's tabs for employers, tabs for employees. There's a tab where you can get answer to questions you have. No small amount of content in today's class is basically cut and paste off of this site. I've gone through and read many of the pages, pulled out the stuff that I think is really relevant that you should know. So if you're looking for where did you get that information, it was probably here somewhere on this site. There's a piece of information here, and that affordable health insurance coverage for families with children, that's called CHIP. And it's possible that you earn too much as a household to qualify for Medicaid, but that your household does qualify for CHIP for your children. That's the Children's Health Insurance Plan. So it could be that you have an employer that is providing single coverage to an employee that is less than 9.5% of that employee's wage, but the employee can't afford to include coverage for the children because it takes them over 9.5%. So they go to the Affordable Care Act site and apply for coverage for the children and find out that based on their income that they don't have to pay anything for health insurance for their children because they fall under CHIP. But you can go back on your own, punch in some numbers, and when you punch in those numbers, it will show you a bunch of different plans. It'll show you bronze plans, silver plans, platinum plans, gold plans. It doesn't matter what plan you choose. The whole point of the actuarial tables and the benefits requirements is that every single plan actually provides the same benefit. They're required to provide the same benefit. The only difference between the plans really ultimately is extras that might be provided that are not required to be provided under the Affordable Care Act, and the amount of the deductible you have to pay and maximum out of pocket. So under a gold plan, the coverage that the gold plan is required to deliver is exactly the same coverage that a bronze plan is required to deliver. They have to provide the same type of coverage. The difference to the individual who is purchasing coverage is how much their deductible is going to be and how much their maximum out-of-pocket is going to be before they actually start to receive benefits from the plan. But that's only for non-preventative stuff. Whether you have a gold plan, a platinum plan, or a bronze plan, all plans have to provide the same preventative at no additional cost. So that would mean your well baby checkups, for women it's mammograms, all of those things must be required to be paid under the plan regardless of the deductible and at no cost out of pocket to the covered. But, for example, this happened to me earlier this year. You're in an accident. In my case, my horse fell on me and I had to get dragged off to the hospital in an ambulance. That is a situation that is not going to be a minimum required amount that has to be provided at no out-of-pocket cost to me. That's where the deductibles kick in. That's where the out-of-pocket maximums kick in. And so I was expected to pay for the cost of those injuries. But if my injuries had been really substantial, then my health insurance would have kicked in and picked up. And the health insurance did pick up some of it, but I was expected to pay some out of pocket. So when employers are required to provide health insurance coverage to their employees, they have to provide a plan that meets those essential minimum coverage requirements. These essential minimum coverage requirements must total less than 9.5% of the employee's household income. If they don't, then the employer has to pay a penalty. So how do we figure out what that penalty is? Well, the penalty for applicable large employers offering coverage that is inadequate or is unaffordable, so inadequate means it wouldn't meet the criteria of one of those plans, or it's unaffordable because it exceeds 9.5% of income, then we run into that penalty provision. Applicable large employers who offer coverage to full-time employees may be subjected to a penalty if the coverage they offer is unaffordable or inadequate, and at least one full-time employee declines coverage because it is inadequate or unaffordable, and then goes to the marketplace, purchases health insurance on the marketplace, and claims a premium reduction credit. So that's a lot of what ifs. The coverage has to cost too much, or it must be inadequate, and Then the employee goes to the marketplace and purchases health insurance through the marketplace and also claims a premium reduction credit at the time they purchase it on the marketplace. If all of those things happen simultaneously, then the employer can be subjected to a penalty. Well, how much is the penalty? Well, it's $250 per month, $3,000 per year for each full-time employee who receives a premium assistance credit. The penalty is adjusted for inflation annually. So what's the limit on the penalty? The penalty cannot exceed the amount of penalty for not offering coverage. The penalty for not offering coverage is the number of full-time employees minus 30 multiplied by $167 per month, which is $2,000 annually. In addition, an employer can be held liable for either penalty in a particular month, but not both. Now, there is also a notice that employers must give to their workers. This notice to employees, the notice is called Notice to Employees of Coverage Options under the Fair Labor Standards Act, FLSA, Section 18B, and updated model election notice under the Consolidated Omnibus Budget Reconciliation Act of 1985. That's a mouthful. So essentially, when an employer hires a worker, the employer is required to provide that worker with particular information. And the information that the employer must provide to the employee is as follows. It generally requires the employers to provide each employee at the time of hiring a written notice that includes the following information. Firstly, it informs the employee of the existence of the marketplace. That place I just took you, the employer has to tell the employee that that marketplace is there. It can't keep it a secret and hope the employee doesn't figure it out. Also, that description must include a description of the services that are provided on the marketplace and the manner in which the employee may contact the marketplace to request assistance, basically a phone number or the website for the marketplace, and that the employee may be eligible for a premium tax credit under Section 36B of the Internal Revenue Code if the employee purchases a qualified health plan through the marketplace, if the employer plan's share of the total allowed costs of benefits provided under the plan is less than 60% of such costs, and if the employee purchases a qualified health plan through the marketplace, the employee may lose the employer contribution, if any, to any health benefits plan offered by the employer, and that all or a portion of such contribution may be excludable from income for federal income tax purposes. So what is this saying? It's saying that the employer, at the time they hire the employee, needs to tell the employee whether or not the employee will qualify for health insurance through the employer, and that the employee can also go to the marketplace to purchase insurance, and that the employee can choose to use the marketplace if the employer fails to provide adequate coverage to the employee. So the employer needs to inform the employee when they hire them, determine whether or not they're full-time or part-time or seasonal. If they determine that they're non-seasonal and full-time, then they have to offer coverage that is affordable if the employer is an applicable large employer. If the employer is not an applicable large employer, then the employer needs to tell the employee they can go to the marketplace to buy insurance. Even if the employer is a large employer, they still need to tell the employee about the health insurance marketplace in the event that the employer fails to provide affordable coverage to that worker or is unable to provide coverage that is affordable for the worker and the worker's children. Did you get all that? So I haven't actually seen an illustration of a particular notice like this. I'm sure there's some out there. But actually, we need to be thinking about our own employees if we have them, providing them with a mechanism for informing them about the marketplace so that they can go there and buy their coverage. It should be in writing. Password number 3 is Sun City, S-U-N-C-I-T-Y, Sun City. Employer reporting requirements. The Affordable Care Act added Section 6055 to the Internal Revenue Code, which provides that every provider of minimum essential coverage will report coverage information by filing an information return with the IRS to administer and individuals to show compliance with the individual shared responsibility provision. So basically, IRS is saying employers need to issue documentation to an employee that tells the employee that they had health insurance coverage, so that the employee can then go to their personal tax return and say, I was covered, and therefore I don't have to pay the individual penalty. The employer also issues that document or a copy of that document to the federal government. So the information reporting requirements are first effective for coverage provided in 2015 by employers. So we're not going to be seeing, at least mandatorily, employers providing a document to their employees for the 2015 tax filing season, because the employer mandate does not become applicable till 2015. The first time we're going to be seeing these documents is 2016. So for 2014, there's no employer requirement to issue reporting documents to employees. But in 2016, employers will need to be issuing them for 2015. There are actually 3 different reporting documents that we as tax practitioners should begin to look for. One of the reporting documents is coming out for the 2015 filing season, and that's the first one that we see here. This particular document is issued to individuals who purchase health insurance through the marketplace. It's a Form 1095A. If you click on the link that is in the manual, it will actually take you to a PDF on the internet, the full form, including instructions for the form. In the manual, I just cut and pasted what would comfortably fit, which is most of page 1. This particular form is issued by the health insurance marketplace. It is provided to individuals who purchase health insurance through the marketplace. The due date for issuing the form is January 31 following year end. Thus, for 2014 tax filers, this document is going to be issued to taxpayers who purchased health insurance through the marketplace by January 31, 2015. The marketplace itself is also required to electronically submit a copy of this Form 1095A to the IRS. Now, beginning optionally in 2014 and mandatorily for 2015, there are 2 other documents to be aware of. The first of these is Form 1095B. It will be provided by health insurance providers to individuals who were covered by health insurance. Providers issuing the form will typically include small employers with fewer than 50 equivalent full-time employees, and the form is used to report the following information: the type of coverage provided to the employee, the period of coverage, and for whom coverage was provided, including each dependent. The health insurance provider will also be required to send a transmittal form 1094B for coverage information to the IRS. Individuals with minimum essential coverage are not subject to the individual shared responsibility payment. So we basically have a hole for 2014 tax year where we need to interview our clients and indicate on the Form 1040 whether or not they had health insurance. If they did not have health insurance, they're subjected to a penalty. How are we supposed to know? How do they prove to us that they had health insurance? Well, for 2015 filing season, it's basically an honor method. There's only going to be a small percentage of filers who will ever receive 1095A because they purchased health insurance through the marketplace. Most individuals are receiving their health insurance through their employers, and for 2014, employers are not required to issue this form. But they can choose to issue it if they want to. I can't see that there would be very many who would do it because it's time consuming, and why would they bother if they're not required to? So I don't really think we're going to be seeing this form other than as an illustration in today's class. But here is Form 1095B that you would typically be looking to see issued by small employers. And then if you are a large employer, you use Form 1095C. Beginning with tax year 2015, employers with 50 or more full-time equivalent employees are required to issue Form 1095C to their employees and submit a copy to the IRS. The form will enable the IRS to track employer compliance with the large employer health insurance mandate that takes effect for 2015, and the form is going to report the following information. Firstly, whether the employer owes any payments under the employer shared responsibility provision beginning in 2015, the eligibility of employees for premium tax credits, and if individuals are subject to the individual shared responsibility payment. And you can see the form provides space to enter the name of each covered individual, whether they were covered all 12 months, and the specific months of coverage, the date of birth, and Social Security number of the covered individual. So that concludes today's coverage of the employer mandate and the federal credits for business that are claimed on Form 3800. We're now going to dive into a completely kind of separate topic, which has to do with a refundable credit that is available to certain businesses. I don't run across it terribly often, being a city slicker like I am, but this would be a credit that would come up fairly often if you are working with farmers regularly. This is a credit that farmers would be able to claim, and there are certain other entities, nonprofit entities and so forth, that can qualify for it as well. So we're going to finish up today's class by taking a look at Form 4136, which is the credit for federal tax on fuels. And if you're a self-pay student, you should pay attention to this because this particular form falls into the homework assignment that we're giving you. And you're going to need to figure the federal tax credit on fuels as a part of the homework assignment. You may be eligible to claim a credit on your income tax return for the federal excise tax paid on certain fuels. You may also be eligible to claim a quarterly refund on the fuel taxes during the year instead of waiting to claim a credit on your income tax return. Whether you claim a credit or a refund depends on whether the fuel was taxed and the purpose, the non-taxable use for which you use the fuel. So essentially what happens is when you go to the gas station and purchase gas or diesel and put it in your car, there's a federal tax included in the cost of that fuel. And that federal tax is intended to pay for highway maintenance, road maintenance. And if you can show that the purchase of this fuel is for a purpose other than driving a vehicle on a public highway, then the rationale is you shouldn't have to pay a tax that is directed at that function. So people who can qualify for this particular credit need to be able to show that they're purchasing fuel. The fuel is being used for a purpose other than use on public highways, except in the case of school buses and so forth, they get it anyway. But in general, when you look at this credit, you start thinking about farmers. They're purchasing fuel for their tractors and for other functions on the farm. But there are a few other groups that qualify for it as well. So let's take a look at the types of business use that can qualify for this refundable credit. And for that, we have a type of use table. The following table lists the non-taxable uses of fuels. You must enter the number from the table in the type of use column on Form 4136 when you are filling it out. The first use listed on the table is on a farm for farming purposes. I've mentioned it several times, and it is the number one choice on the form. Number two, also, we have off-highway business use. This is for business use other than in a highway vehicle registered or required to be registered for highway use. Also for export. Number four, in a boat engaged in commercial fishing. So if you are a fisherman and you have your fishing boat and you are putting fuel into that fishing boat for use in your commercial fishing, you can get a refund of a certain portion of the tax you're paying at the gas pump on that. Number five, in certain intercity and local buses, in a qualified local bus, in a bus transporting students and employees of schools, in other words, school buses. For diesel fuel and kerosene, other than kerosene used in aviation, used other than as a fuel in the propulsion engine of a train or diesel-powered highway vehicle, but not off-highway business use. In foreign trade, for certain helicopter and fixed-wing aircraft uses. Exclusive use by qualified blood collector organization. In a highway vehicle owned by the United States that is not used on a highway. Exclusive use by a nonprofit education organization. Exclusive use by a political subdivision of a state or the District of Columbia, in an aircraft or vehicle owned by an aircraft museum, and in military aircraft. So any of those types of use of fuel, at the gas pump, these organizations are going to be paying this tax. And if they are going to need to be able to show that the gas or the fuel was used for a qualified purpose, in other words, a purpose that is a non-taxable use of the fuel, non-taxable for purposes of the tax collected at the pump. And if you can show that, then you get to claim the credit. So I'm going to look at a few of these in a little bit more detail, not all of them. Go numb if I looked at all of them, but I wanted to look at a few of them and look at some of the rules that apply to a few of them so that you have a better understanding. Firstly, use number one, which is on a farm for farming purposes. On a farm for farming purposes means fuel used in carrying on a trade or business of farming on a farm in the United States and for farming purposes. Examples of fuel used on a farm for farming purposes include fuel used in the application of fertilizer, pesticides, or other substances including aerial applications. Number 2, off-highway business use. Off-highway business use means fuel used in a trade or business or in an income-producing activity other than as a fuel in a highway vehicle registered or required to be registered for use on public highways. Off-highway business use generally does not include any use in a motorboat. Off-highway business use includes fuels used in any of the following ways. In stationary machines such as generators, compressors, power saws, and similar equipment. For cleaning purposes, for forklifts, bulldozers, and earth movers. Generally, this use does not include non-business use of fuel, such as use by mini bikes, snowmobiles, power lawnmowers, chainsaws, and other yard equipment. And here is an example of what we mean. We have qualified non-highway business use. Caroline owns a landscaping business, and she uses power lawnmowers and chainsaws in her business. The gasoline used in the power lawnmowers and chainsaws qualifies as fuel used in an off-highway business use. The gasoline that she uses in her personal lawnmower at her home does not qualify. Number 4, in a boat engaged in commercial fishing. Fuel used in a boat engaged in commercial fishing means fuel used in taking, catching, processing, or transporting a fish, shellfish, or other aquatic life for commercial purposes, such as selling or processing the catch on a specific trip basis. They include boats used in both fresh and saltwater fishing. They do not include boats used for both sport fishing and commercial fishing on the same trip. Number 8, diesel fuel and kerosene, other than kerosene used in aviation, used other than as a fuel. Diesel fuel and kerosene used other than as a fuel in the propulsion engine of a diesel-powered highway vehicle or diesel-powered train means undyed diesel fuel and undyed kerosene fuel that is used for home heating, lighting, and cooking, in boats, in stationary machines such as generators and compressors, for cleaning purposes, or in mini bikes and snowmobiles. You should refer to publication 510, Excise Taxes, and the instructions for Form 4136 for more detailed definitions of the terms used in the table for non-taxable use of fuels in claiming a credit for tax paid on these fuels. Now, there's a lot more to read. For example, if you're preparing a non-profit return and there's a vehicle that is being used for a non-profit entity, you'd have to go through and read the instructions to see if that non-profit use qualifies. And if obviously you have a farmer or you have a fisherman or you maybe have a landscaping business that could possibly qualify for the credit, now you're going to move into the record-keeping requirements, because in order to claim this credit, you have to actually have records that show the non-business use. So it's important to maintain records to establish that you are the person who is entitled to claim a credit or refund and the amount that you claimed. You do not have to use any special form, but the records should establish the following information: the total number of gallons bought and used during the period covered by your claim, the dates of the purchase of the fuel, the names and addresses of suppliers and the amounts bought from each during the period covered by the claim, the non-taxable use for which you used the fuel, and the number of gallons used for each non-taxable use. It is important that your records separately show the number of gallons used for each non-taxable use that qualifies as a claim. And then, after you have claimed the credit, you're going to have to include any refund that you receive in income the next year. So here's how it works. You go to the gas pump and you buy the fuel. You then claim a deduction for the cost of the fuel you buy. When you file your tax return, you claim a credit for the tax that you paid on that fuel, and that credit comes back to you as a refund. Well, you've now got money coming back to you that you previously claimed an expense deduction for. So you think about it like in terms of claiming a deduction on Schedule A for your income taxes paid to your state. You claim a deduction on Schedule A for taxes paid to the state. You then file a state tax return and receive a refund of some of those taxes. That refund then the next year gets entered as income. Same exact concept for purposes of including the refund for credit on fuels in the income of the business. The business claims a deduction when it buys the fuel. When it files the 1040 return or the business return at the end of the year, it claims a credit for the tax paid on that fuel. That credit is going to be issued as a refundable credit to the business. The next year, the business has to include that refundable credit as income on its tax return again. And here is an illustration. In 2014, Jake claimed a credit for excise tax on fuels of $300 on his 2013 return. So in 2014, he's receiving a credit from his 2013 return. When he files his 2014 Schedule C, he's going to report that $300 credit as other income on line 6 of Schedule C. And I had a few Schedule C's in here. Let me pop up and just show you that line 6 if you can't just picture it in your head. It's way up here under George Burns, wasn't it? George Burns, here we are. So line 6, right here, other income. So if your client is eligible for that federal tax credit on fuels, the year in which they receive that refund, when you prepare the tax return for the year in which they receive that refund, it would be listed as other income on line 6. And obviously, if you're dealing with an S corporation, which was the next one in line here, the Bear House, there's a line for it here, other income, line 5 on the Form 1120S. So it's just something to bear in mind as a tax preparer, that when they receive these refundable credits for the tax on fuels, then the next year, whatever that credit was, is going to be bumped into income. All right, so that's it. We're finished with today's class. The only extra information I threw in the manual for you was just a complete copy of Form 4136. I haven't gone through and done a detailed breakdown of the form and how it works, but for the homework assignment for self-paced students, we have provided a very simple illustration that is asking you to take a look at this form, figure out what code to enter on it, figure out what section to enter it in, and figure the credit. It's not difficult to do. It's a multi-page form, but you really only fill out the small section of the form that applies to the particular fuel purchased. And then the last bit here is the homework assignment. And the homework assignment involves preparation of a tax return for Aladdin Birch. Now, those of you who are live webcast students today, we actually don't have the answer key for the homework assignment loaded. You're not going to be able to look at it. We just haven't had time to do the answer key. We just had enough time to create the problem. And by the time this course is loaded as a self-paced course, we will have an answer key in there. But if you do want to look at the answer key for chick yolk, that classwork assignment answer key is loaded into the LMS, and you can go print that out if you want to keep a copy for your records. So I'll give you the final password for the day. We hope you've enjoyed this tax education class. Pacific Northwest Tax School is approved as a CE provider by the IRS and the states of Oregon, New York, and Texas. We have been awarded the Quality Assurance Standard by NASBA and meet the CE requirements for CPAs in most U.S. states and territories. Tax clients demand knowledge and experience. Pacific Northwest Tax School provides the in-depth, practical education needed to improve your understanding of tax law and to meet the demands of the competitive tax preparation industry.